Welcome, everyone. I'm absolutely delighted to have you here today for what I believe will be a truly transformative learning experience. We're about to embark on a comprehensive journey through the fascinating world of top-down analysis in trading. Now, you might be looking at your screen and wondering, what exactly is top-down analysis and why should I care? Well, let me tell you. This methodology is absolutely fundamental to becoming a consistently profitable trader. It's the difference between trading blindly and trading with precision, confidence, and clarity. The title you see before you, Top-Down Analysis Made Easy, isn't just a catchy phrase, it's a promise. You see, many traders struggle with this concept because they're overwhelmed by the complexity, the multiple timeframes, the conflicting signals. But here's the brilliant thing. It doesn't have to be complicated. In fact, when you understand the underlying principles, it becomes remarkably straightforward. What we're going to explore together is a comprehensive guide to mastering multi-timeframe analysis. Think of it as learning to read the market like a professional, starting with the big picture, the macro view, if you will, and then progressively drilling down into finer and finer details until you find those perfect, high-probability trading opportunities. This isn't just theory, mind you. We'll be covering practical, actionable strategies that you can implement immediately. Whether you're a complete beginner who's just starting your trading journey, or you're an experienced trader looking to refine your approach, this presentation has been carefully designed to meet you exactly where you are and take you to the next level. Over the course of this presentation, we'll demystify everything from understanding timeframe selection to reading market structure to identifying precise entry and exit points. We'll examine real-world examples, discuss common pitfalls, and most importantly, we'll give you a systematic framework that you can rely on day after day. So, I encourage you to engage fully with this material. Take notes, pause when you need to reflect, and don't hesitate to revisit sections as needed. Remember, mastery comes through understanding and practice, and we're here to ensure you have both. Right then, shall we begin this exciting journey? Let's dive in.
Right then, let's dive into our first critical concept, why timeframe selection matters. And I must say, this is absolutely fundamental to everything we're going to discuss moving forward. You see, timeframes, they're not just arbitrary settings on your trading platform. Oh no, far from it. They are, quite literally, the backbone of your entire trading strategy. Think of them as different lenses through which you view the market. Each lens reveals something unique, something essential. Now, when I speak to traders, particularly those who are struggling, I often find that their challenges stem from one simple mistake. They're looking at the wrong time frame. Or worse, they're looking at just one time frame and expecting it to tell them the complete story. It's rather like trying to understand a building by only looking at one floor, isn't it? You need the aerial view, you need the ground level perspective, and you need everything in between. So, what exactly does the right time frame selection give you? Well, there are three absolutely critical benefits I want you to understand. First, it helps you find your market direction. This is your compass, your North Star, if you will. Without knowing the overall direction the market is heading, you're essentially trading blind. The proper time frame shows you whether you should be looking for buying opportunities or selling opportunities. It's that straightforward. Second, and this is equally important, it helps you identify precise entry signals. You see, once you know where the market is heading, you need to know exactly when to get in. Too early, and you might face unnecessary drawdown. Too late, and you've missed the optimal risk to reward opportunity. The right time frame gives you that sweet spot, that perfect moment of entry. And third, and this is what we all care about at the end of the day, isn't it? It dramatically improves your overall profitability. When you're trading in harmony with the correct time frames, you're making decisions based on complete information. You're not fighting the market, you're flowing with it. And that, my friends, makes all the difference. Now here's where top-down analysis becomes absolutely brilliant. Instead of relying on a single time frame, which, as I mentioned, gives you an incomplete picture, top-down analysis utilizes multiple time frames in a systematic, organized way. You start with the broader view to understand context, then progressively drill down to find your precise entry point. It's a methodical approach, yes, but it's also elegant in its simplicity. And as we move through this presentation, you'll see exactly how these timeframes work together to create a comprehensive trading framework. So remember this foundational principle. Time frame selection isn't just important, it's essential. Get this right, and everything else falls into place.
Excellent! Now that we understand why time frame selection is so crucial, let's explore the 3 key approaches you can use in your trading. And I must say, this is where things become quite practical and rather exciting. You see, one of the most common questions I receive from traders is, how many time frames should I actually be using? And the answer, my friends, is wonderfully flexible. You have 3 distinct approaches to choose from, and each has its own particular strengths. Pause for emphasis. Let me walk you through them, starting with what I consider the gold standard, the 3 time frame system. Now, this is represented by the number 3 here, and it's highlighted in green for a very good reason. This is the most comprehensive approach available to you. How does it work? Well, you start with your higher time frame. This gives you your market direction, your overall bias. Then you move to your intermediate time frame, where you refine those points of interest you've identified. And finally, you drop down to your lower time frame for your actual entry execution. It's balanced, it's thorough, and it provides detailed analysis at every level. Think of it as having 3 different perspectives on the same market: the aerial view, the street view, and the magnified view, all working together harmoniously. Now, for those of you who prefer a more streamlined approach, we have the 2 time frame system. This is quite popular among experienced traders who've developed a strong intuition for market reading. Here, you're essentially condensing the process. Your higher time frame handles both direction and points of interest, whilst your lower time frame takes care of entries and any necessary refinements. It's efficient, it allows for faster decision-making, and honestly, once you've mastered the 3 time frame approach, transitioning to 2 frames can be quite liberating. And then, and this might surprise some of you, we have the single time frame system. Now, before you dismiss this as overly simplistic, let me tell you something important. This can be remarkably effective, but with one critical caveat. You absolutely must backtest this approach thoroughly before implementing it in live markets. With a single time frame, let's say the 4-hour chart for example, you're doing everything on that one chart. You're finding your direction, identifying your points of interest, and taking your entries, all from the same time frame perspective. It's ultra simplified, yes, but it requires a deep understanding of price action and market structure. Now, which approach should you choose engagingly? Well, that's rather like asking which tool from a toolbox is best. It entirely depends on what you're building, doesn't it? If you're a beginner, I strongly recommend starting with the 3 time frame system. Get comfortable with that comprehensive view. As you develop your skills and your confidence grows, you might find yourself naturally gravitating toward the 2 time frame approach. And perhaps eventually, you'll experiment with the single time frame method for certain market conditions. Enthusiastic closure. The beauty of having these 3 approaches is that they're not mutually exclusive. You might use 3 time frames for your swing trades, 2 for your day trades, and experiment with one for very specific setups. Flexibility, my friends, is the key to long-term trading success. Now, let's delve deeper into what I consider the gold standard, the 3 time frame system. And I say gold standard quite deliberately, because this approach offers you the most comprehensive view of the market you can possibly achieve. Think of this system as your trading telescope, if you will. You have 3 distinct lenses, each providing a unique perspective, yet all working together to give you the complete picture. It's rather elegant, actually, once you see how the pieces fit together. So let's break this down systematically. Your first component, and this is absolutely crucial, is your higher time frame. This is where everything begins. Now, what are you doing on this higher time frame? You're establishing your market direction. You're determining your overall bias. Are we in a bullish market? Are we in a bearish market? Are we in consolidation? This is where you answer these fundamental questions. You're also identifying your major points of interest, those key zones where price has historically reacted or where you anticipate future reactions. Think of the higher time frame as standing atop a mountain, surveying the landscape below. You can see the rivers, the valleys, the general terrain. You understand the lay of the land. That's precisely what the higher time frame gives you: context, perspective, the big picture view. Now, once you have that established, you move to your intermediate time frame. And this is where things become rather interesting. You see, on the higher time frame, you might have identified, let's say, a rather large order block or a significant fair value gap. But here's the thing. If you tried to enter a trade immediately when price touches that zone on the higher time frame, you might find yourself stopped out prematurely. Why? Because you haven't refined your zone. You haven't narrowed it down to the most probable reaction point. This is where the intermediate time frame absolutely shines. You're taking those broad zones from your higher time frame and you're refining them. You're asking yourself, within this larger zone, where specifically is price most likely to react? Perhaps there's a smaller order block within the larger one. Perhaps there's a liquidity pool that needs to be swept first. You're adding layers of precision to your analysis. And finally, and this is where execution meets analysis, you have your lower time frame. This is your entry time frame. This is where you're waiting for your confirmation signals. Perhaps you're looking for a change of character. Perhaps you're waiting for a specific candlestick pattern. Perhaps you need to see a break of structure on this lower time frame before you commit capital. The lower time frame is where theory transforms into action. It's where you pull the trigger, so to speak. And because you've done your homework on the higher and intermediate time frames, you're entering with confidence, with context, with a clear understanding of why you're taking this particular trade. Now, here's what makes this 3 time frame system so remarkably balanced. You're getting detailed analysis at every level. You're not rushing your decisions. You're building conviction layer by layer. And this, my friends, is what separates professional traders from amateurs. The professionals are patient. They're methodical. They understand that proper analysis takes time, but it's time extraordinarily well spent. This system is adaptable to virtually any strategy you might employ. Whether you're swing trading, day trading, or even position trading, the 3 time frame approach provides you with the structure you need to make informed, intelligent decisions.
Right, now let me show you something really quite brilliant. This is the visual representation of the 3 time frame system in action, and I think you'll find this remarkably illuminating once you see how these 3 components flow together. Now, what you're looking at here is the complete journey from analysis to execution. It's a systematic progression, and each stage builds upon the previous one. Think of it as a funnel, if you will. We're starting broad and progressively narrowing our focus until we arrive at that perfect moment to enter a trade. So, let's begin at the start. Your higher time frame, and in this example, we're using the 4-hour chart. Now notice the mountain icon here. I chose that quite deliberately because this is your vantage point, isn't it? You're standing at the peak, looking out over the entire landscape. From this elevated position, you can see everything: the major trends, the significant support and resistance levels, the overall market direction. What are you actually doing on this 4-hour chart? You're finding your overall trend. Are we in a bullish phase? Are we bearish? Are we consolidating? And you're identifying your major points of interest, perhaps order blocks, fair value gaps, significant supply and demand zones. These are your anchor points, the foundations upon which your entire trade setup will be built. Now, once you've established that context, and this is crucial, you must have that higher time frame context first. You then progress to your intermediate time frame. Here we're using the 15-minute chart, and I want you to notice the compression icon. This is intentional, because at this stage we're compressing our focus. We're taking those rather large zones we identified on the 4-hour chart, and we're refining them. This is where the artistry of trading really comes into play. You see, on the 4-hour chart, you might have identified an order block that spans, let's say, 50 pips, but you don't want to enter the moment price touches the top of that zone. You could get stopped out unnecessarily. Instead, on the 15-minute chart, you're looking within that larger zone for more precise areas of interest. Perhaps there's a smaller order block nested within. Perhaps there's a fair value gap that needs to be filled first. You're adding layers of precision to your analysis. And then, and this is where theory transforms into action, you move to your lower time frame, in this case the 5-minute chart, represented here by the crosshairs icon. And that's exactly what this stage is about. You're taking aim. You're preparing to execute. On this 5-minute chart, you're not doing broad analysis anymore. You're waiting for your entry trigger. Perhaps it's a change of character. Perhaps it's a specific candlestick pattern. Perhaps it's a break of structure that confirms your bias. Whatever your entry criteria may be, this is where you're watching it. This is where you commit your capital. Now look at these arrows connecting each stage. They're not just decorative. They represent the logical flow of your analysis. You cannot skip stages. You don't jump from the 4-hour straight to the 5-minute without considering the 15-minute context. Each time frame serves a specific purpose, and together they create a comprehensive framework. What I particularly love about this visual representation is how clean and systematic it is. Higher time frame, green, representing opportunity and direction. Intermediate time frame, blue, representing focus and refinement. Lower time frame, red, representing execution and precision. It's a color-coded roadmap for your trading decisions. And here's something that often gets overlooked. This system isn't rigid. Yes, we're showing 4-hour, 15-minute, and 5-minute in this example, but you could just as easily use daily, 4-hour, and 15-minute for swing trading, or 15-minute, 5-minute, and 1-minute for scalping. The principle remains exactly the same. Start broad, refine progressively, execute precisely. This, my friends, is systematic trading at its finest.
Now then, let's discuss something that I think many experienced traders will find particularly appealing: the 2-time frame system. And I must say, once you've mastered the 3-time frame approach, transitioning to this streamlined method can be absolutely liberating. You see, the 2-time frame system is all about efficiency without sacrificing accuracy. It's simple, it's elegant, and when executed properly, it's remarkably effective. Think of it as the refined version. You've learned all the fundamentals, and now you're condensing the process into a more streamlined workflow. So how does it work? Well, you're essentially combining functions that were previously separated. Your higher time frame now serves a dual purpose. First, it establishes your market direction. Are we bullish, bearish, or consolidating? That's your primary question. But second, and this is where the efficiency comes in, you're also identifying your points of interest directly on this higher time frame. You're not waiting to drop down to an intermediate level, you're doing it all in one go. Now, you might be thinking, but doesn't that mean we're missing some precision? And that's a fair question. But here's the thing. Once you've developed a strong intuition for reading market structure, and this really does come with experience, you don't necessarily need that intermediate layer. You can identify precise zones on your higher time frame because you've trained your eye to see the patterns, to recognize the confluences, to spot those high probability areas. Then you move directly to your lower time frame. And this is where all your action happens. You're looking for your entry signals, your confirmation triggers. Perhaps it's a change of character. Perhaps it's a specific candlestick formation. Perhaps it's a break of structure that validates your higher time frame analysis. Whatever your criteria may be, this is where you execute. But there's another crucial function happening on this lower time frame: refinement. Yes, even though we've skipped the intermediate level, we can still refine our zones if necessary. If your higher time frame point of interest is rather large, you can use your lower time frame to narrow it down at the moment of entry. You're essentially doing your intermediate work in real time as price approaches your zone. Now, let's talk about the advantages of this approach. First and foremost, speed. Faster decision-making is absolutely critical in certain market conditions. If you're trading particularly volatile markets or fast-moving sessions, having one less time frame to analyze can make the difference between catching an opportunity and missing it entirely. Second, it's less cluttered mentally. You're not juggling 3 different perspectives simultaneously. You have your macro view, your micro view, and that's it. For some traders, particularly those with significant experience, this mental simplicity actually improves their trading performance because they're not second-guessing themselves across multiple time frames. And third, and I find this particularly interesting, this approach forces you to develop stronger analytical skills. When you don't have that intermediate safety net, you become more precise with your higher time frame analysis. You learn to identify better zones from the start because you know you're going straight to execution. Now, a word of caution. This isn't necessarily for beginners. I would strongly recommend mastering the 3 time frame system first. Get comfortable with that comprehensive approach. Understand how each time frame contributes to the overall picture. Then, once you've developed that foundation, once you've built that intuition, the 2 time frame system becomes a natural evolution of your trading methodology. This is quite popular among experienced day traders and scalpers who need to make rapid decisions but still want that higher time frame context. It's that sweet spot between comprehensive analysis and efficient execution.
Right then, let's have a proper look at the visual representation of our 2 time frame system, shall we? And I must say, this diagram really does illustrate rather beautifully how elegantly streamlined this approach can be. Now, what you're observing here is the complete workflow condensed into just 2 essential stages. It's remarkably efficient, isn't it? Rather like taking the motorway instead of the scenic route. You're still reaching your destination, but you're doing so with considerably less complexity along the way. So let's begin with the first component, your higher time frame. In this particular example, we're utilizing the 4-hour chart, represented here by that mountain icon. And that mountain imagery is quite deliberate, I assure you. You're standing at elevation, surveying the entire landscape, taking in the full panorama of market activity. But here's where this system differs from our 3 time frame approach. On this higher time frame, you're accomplishing 2 critical tasks simultaneously. First, you're establishing your market direction. Are we bullish, bearish, or ranging? That's your fundamental question. But second, and this is where the efficiency truly shines through, you're also identifying your major points of interest directly on this chart. You're marking out your order blocks, your fair value gaps, your supply and demand zones all in one go. Now, this does require a certain level of competence, I must be frank with you. You need to have trained your eye to spot these zones with precision on the higher time frame, because you won't have that intermediate buffer to fall back on. It's rather like learning to drive a manual transmission. Initially, it seems daunting, but once you've mastered it, it becomes second nature. Notice the color coding here. We've got green for our higher time frame, which rather nicely represents opportunity and analysis. The entire box is framed in that vibrant green,
signifying that this is where your foundational work takes place. Now follow that arrow connector across to the right. This represents your progression, your workflow moving from analysis directly to execution. There's no intermediate stop, no middle station. You're going straight from macro view to micro execution. And here we arrive at your lower time frame, depicted with the crosshairs icon, which I think is rather apt, wouldn't you say? You're taking aim, preparing to execute your trade. In this example, we're showing both 15-minute and 5-minute options because, quite frankly, this is where you have flexibility. Some traders prefer the 15-minute for entries, whilst others feel more comfortable with the 5-minute granularity. Both work splendidly well. It really comes down to your personal preference and trading style. Now, what's happening on this lower time frame? Well, you're doing two things. First, you're refining those zones you identified on the 4-hour chart. If you've marked out a rather large order block, you can use this lower time frame to narrow it down at the moment price approaches. You're essentially performing your intermediate analysis in real time as the setup develops. Second, and this is most crucially, this is where you're waiting for your entry triggers, your change of character, your break of structure, your candlestick confirmations, whatever your entry criteria might be. This is where theory transforms into action, where analysis becomes execution. Notice the red color coding here for this lower time frame. Red signifying action, execution, the commitment of capital. It's a visual reminder that when you're on this time frame, you're in execution mode. What I particularly appreciate about this visual representation is how it emphasizes the direct connection between these two timeframes. That arrow isn't suggesting a casual relationship. It's showing you a deliberate, purposeful progression. You cannot skip stages. You cannot jump to the lower time frame without first doing your homework on the higher time frame. This approach, the two time frame system, is particularly popular amongst experienced day traders who've developed that intuitive market reading ability. They can look at a 4-hour chart and immediately identify high probability zones without needing that intermediate layer of confirmation. It's faster, it's cleaner, and for those who've earned their stripes, it's remarkably effective. But let me emphasize once more, this isn't where you should begin if you're new to trading. Master the 3 time frame approach first, develop that comprehensive understanding, and then, once you've built that foundation, transition to this more streamlined methodology. Brilliant stuff, really. Efficiency without sacrificing effectiveness.
Right then. Now we arrive at what some might consider the most controversial approach, the single time frame system. And I say controversial quite deliberately because this method divides opinion rather sharply amongst traders. Now, what precisely is this single time frame approach? Well, it's exactly what it says on the tin, isn't it? You're doing absolutely everything, finding your market direction, identifying your points of interest, refining those zones, and executing your trade entries, all on one solitary chart. Perhaps you're using the 4-hour chart, or the 15-minute, or even the daily. The specific time frame isn't what's crucial here. What matters is that you're conducting your entire analysis within that single time frame perspective. Some of you might be thinking, good heavens, that sounds terribly risky. And I must confess, I understand that instinct. We've spent considerable time discussing the virtues of multi-time frame analysis, haven't we? The comprehensive view, the layered confirmation, the refined precision. And now here I am telling you that some traders, quite successfully mind you, operate on just one time frame. So how on earth does this work? Well, let me explain. When you're analyzing on a single time frame, let's say the 4-hour chart for this example, you're looking at that chart and extracting everything you need. You're identifying the overall trend direction.
You're spotting your major highs and lows, your breaks of structure, your changes of character. You're marking out your order blocks, your fair value gaps, your supply and demand zones, and you're watching for your entry triggers, all on that same 4-hour chart. Now, the key badge points you see on the slide here: market direction, find and refine POIs, trade entries, target selection. These aren't suggestions, they're essential functions you must perform on that single time frame. You cannot skip any of them simply because you're working on one chart. The discipline remains just as rigorous. But here's the absolutely critical caveat, and I cannot emphasize this strongly enough. You must backtest this approach thoroughly before implementing it in live markets. Notice that warning box highlighted in red. That's not decorative, that's a proper cautionary notice. This methodology requires a deep, intuitive understanding of price action. You need to have spent considerable time observing how markets behave on your chosen time frame. You need to recognize patterns, understand context, read between the lines, so to speak. Who might this approach suit? Well, in my experience, it's particularly effective for two groups of traders. First, those who've developed such a strong understanding of market structure on a specific time frame that dropping down to additional time frames actually creates confusion rather than clarity. They've trained their eye so thoroughly that they can spot everything they need on one chart. Second, swing traders who operate on higher time frames, perhaps the 4-hour or daily charts, where price action is slower, more deliberate, and patterns are clearer. On these higher time frames, you have more time to analyze, more time to think, and frankly, the signals tend to be more reliable. Now, I should mention that this isn't where I'd recommend a beginner start. No, definitely not. If you're new to trading, please do begin with the 3 time frame system. Master that comprehensive approach first. Understand how different time frames interact, how they confirm or contradict each other. Build that foundation properly. But once you've established that foundation, once you've developed that market reading intuition, the single time frame approach can offer remarkable simplicity. There's something rather liberating about not having to juggle multiple charts simultaneously. Your focus becomes laser sharp. Your decision-making becomes more direct. The 4-hour chart, which I've mentioned several times, is particularly well suited for this approach amongst beginners who wish to explore single time frame trading. It offers enough price action to be meaningful whilst not being so fast-moving that you're overwhelmed. You have time to think, time to analyze, time to make considered decisions. But whatever you do, please remember, backtest thoroughly. Prove to yourself, with data, that this approach works for your particular trading style and market conditions before risking real capital. That's not optional, that's absolutely essential. Ultra simplified? Yes. Effective when done properly? Absolutely. But it requires skill, discipline, and thorough preparation.
Excellent! Now we've arrived at section 2, and this is where we're going to properly define what top-down analysis actually is. And I must say, understanding this definition thoroughly is absolutely crucial to everything that follows. So, what precisely is top-down analysis? Well, let me give you the formal definition and then we'll unpack it together, shall we? Top-down analysis is a methodical approach where you begin by analyzing the big picture, what we might call the macro market view. You're considering overall market structure, economic factors, and various key elements. Then, progressively, you narrow down your focus to smaller time frames. This strategic method helps you make more informed trading decisions by aligning with larger trends. Now, that might sound rather technical, so let me put it in simpler terms. Imagine you're looking at a map of the entire United Kingdom. At first, you're viewing the whole country, the general geography, the major cities, the primary motorways. That's your macro view. Then you zoom in to a particular region, perhaps London. You can now see individual boroughs, specific roads, landmarks. That's your intermediate view. Finally, you zoom in even further to a particular street, a specific building. That's your micro view, your entry point. That's precisely what top-down analysis is in trading. You're starting with the broad perspective and systematically narrowing your focus until you arrive at a precise trading opportunity. Now, let's break down the key components you see on this slide. First, we have macro to micro. This represents your analytical journey. You're literally moving from the largest possible view down to the smallest actionable detail. It's a funnel approach, if you will, and it's remarkably effective because it provides context at every level. Second, we have market structure. This is fundamental. You're examining the overall trend, the major highs and lows, the breaks of structure, the changes of character. Market structure tells you the story of what's been happening and, to some extent, what's likely to happen next. Third, points of interest. These are your key zones, your order blocks, your fair value gaps, your supply and demand areas. These are the locations where you anticipate price might react. They're rather like landmarks on your map, aren't they? They give you reference points for your trading decisions. And fourth, liquidity zones. This is where things become rather interesting. You're identifying areas where liquidity has been swept or where it still needs to be swept. Understanding liquidity is absolutely critical to modern price action trading. It's what drives significant market moves. Now, why is this top-down approach so powerful? Well, it's because you're building a comprehensive narrative about what the market is doing. You're not just looking at price action on a single time frame and hoping for the best. No, you're constructing a complete picture from multiple perspectives, and then you're making your trading decisions based on that complete understanding. Think of it this way. If I asked you to paint a portrait of someone only based on seeing their left ear, you'd struggle rather significantly, wouldn't you? But if I showed you their full face from multiple angles under different lighting conditions, you'd be able to create a far more accurate and detailed portrait. That's exactly what top-down analysis does in trading. It gives you multiple perspectives that together create a complete picture. This isn't just theory, mind you. This is how professional traders, institutional traders, approach the markets. They're not frantically jumping from one time frame to another without purpose. No, they have a systematic, methodical process, and top-down analysis is at the heart of that process. So, as we move forward through this presentation, keep this definition in mind. Everything we discuss, the time frames, the market structure, the entry criteria, it all fits within this broader framework of top-down analysis. We're building a complete trading methodology layer by layer, just as the approach itself moves from macro to micro. Brilliant concept, really. Simple in principle, powerful in practice.
Right then. Now that we've established what top-down analysis is, let's discuss why you should actually care about using it. What's the purpose? What are the tangible benefits? And I must tell you, these benefits are not trivial.
They're absolutely transformative for your trading results. Let's start with the first major benefit, identifying the overall trend. Now, you might be thinking, well, of course I need to know the trend. That's rather obvious, isn't it? But here's the thing. Most traders struggle with this seemingly simple task. They look at a chart and see conflicting signals. They get whipsawed because they're trading against the dominant trend. Top-down analysis solves this problem brilliantly. By starting with your higher time frame, you're determining the market direction before entering any trades. You're asking yourself, is this market bullish? Is it bearish? Or are we in a consolidation phase? And you're answering this question with confidence because you have the broader context. You're not guessing, you're analyzing systematically. Think of it like checking the weather forecast before planning a day out. You wouldn't organize a garden party without knowing whether it's going to rain, would you? Similarly, you shouldn't enter trades without knowing the overall market direction. It's fundamental risk management. The second benefit, and this is where things become rather exciting, is uncovering major points of interest and liquidity pools. These are your high probability zones, the areas where price is most likely to react. Now, when you're using top-down analysis, you're not just finding any old support or resistance level. No, you're identifying key zones that are confirmed across multiple time frames. Perhaps you spot a significant order block on the 4-hour chart. Then you drop down to the 15-minute and discover it aligns perfectly with a fair value gap. Suddenly, you're not looking at one piece of evidence, you have confluence, you have confirmation. That's powerful. That dramatically increases the probability of your trade working out. And regarding liquidity pools, understanding where liquidity rests is absolutely critical. Institutional traders, the big players, they need liquidity to execute their large orders. By identifying these zones through top-down analysis, you're essentially seeing where the smart money is operating. You're trading alongside the institutions rather than becoming their exit liquidity. That's a rather significant advantage, wouldn't you say? The third benefit is increasing the probability of successful trades by aligning your bias. This is perhaps the most important point. You see, trading isn't about being right 100% of the time. That's impossible. What it is about is stacking probabilities in your favor. Every confirmation you add, every piece of confluence you identify, you're incrementally increasing your probability of success. When you use top-down analysis, you're ensuring that your lower time frame trades align with your higher time frame bias. You're not fighting the tide, you're flowing with it. If your 4-hour chart says we're bullish, you're looking exclusively for buying opportunities on your lower time frames. You're not getting distracted by counter-trend setups that look tempting but are statistically less likely to succeed. And finally, and this ties everything together, you're making structured, repeatable decisions. This is crucial for long-term trading success. You cannot rely on gut feelings or random analysis. You need a system, a methodology that you can apply consistently, day after day. Top-down analysis provides that structure. You follow the same process for every trade. Analyze higher time frame, identify points of interest, drop to intermediate, refine zones, move to entry time frame, wait for confirmation, execute. It's systematic, it's repeatable, and it removes emotional decision-making from the equation. Now, I want you to consider something for a moment. Professional traders, those who've been consistently profitable for years, they all have one thing in common. They have a structured process. They don't wing it. They don't jump from one random idea to another. They follow their methodology religiously, and top-down analysis is very often at the core of that methodology. These benefits aren't theoretical. They're practical, tangible advantages that will show up in your trading results. better trade selection, higher win rates, improved risk-to-reward ratios, more confidence in your decisions. That's what proper top-down analysis delivers, absolutely invaluable for serious traders.
Excellent. Now we're going to break down the strategic approach to implementing top-down analysis. This is your step-by-step roadmap, and I want you to think of these 4 stages as your trading ritual, something you do before every single trade without exception. Step 1. Analyze macro structure. This is where everything begins, and I cannot emphasize enough how critical this first step is. You start with the big picture view, your higher time frame. What are you doing here? You're identifying overall trend direction, major market phases, key support and resistance levels, and significant liquidity zones. Now let me be very clear about something. You cannot skip this step. You cannot rush through it. This is your foundation, and if your foundation is shaky, everything built upon it will be unstable. Take your time here. Look at your chart properly. Ask yourself, what story is this market telling me? Where has price been? Where is it likely headed next? You're marking out your major swing highs and lows. You're identifying whether we're in a trending market or a ranging market. You're noting areas where liquidity has been swept or where it still remains. This macro structure gives you your trading bias for the session. If the macro structure says bullish, you're looking for buying opportunities. If it says bearish, you're hunting for shorts. It's that straightforward. Step 2. Drill down to find and refine setups. Now you're moving from the broad view to something more specific. You've established your bias on the higher time frame. Now you're dropping down, perhaps to your intermediate time frame, to identify precise setups. Perhaps you've identified on the 4-hour chart that price should react around a certain zone. Now, on the 15-minute chart, you're looking within that zone for more precise areas of interest. Maybe there's a smaller order block nested within the larger one. Perhaps there's a fair value gap that provides additional confluence. You're essentially taking that rather broad higher time frame analysis and sharpening it, making it actionable. It's rather like using a telescope. First, you spot the general area where you want to look, then you adjust the focus to see the details more clearly. Step 3. Confirm entries on granular levels. Now we're getting into execution mode. You've done your macro analysis, you've identified and refined your setup, and now you're waiting for your entry trigger on your lowest time frame. Now here's what I want you to understand. Confirmation is not optional. Too many traders see price approach their zone and immediately enter, hoping it will work out. That's gambling, not trading. You wait for your confirmation. You let price prove to you that it's ready to move in your anticipated direction. Only then do you commit capital. Step 4. Execute with alignment for optimal results. This is where everything comes together. You've analyzed the macro, refined your setup, confirmed your entry, and now you execute. But notice the key word here, alignment. Your entry on the lower time frame is aligned with your intermediate time frame setup, which is aligned with your higher time frame bias. Everything is pointing in the same direction. You have confluence, you have confirmation, you have conviction. That's when you take the trade. And when you execute with this level of alignment, something remarkable happens. Your trading becomes far less stressful. You're not second-guessing yourself because you've done the work. You followed your process. You have multiple layers of confirmation supporting your decision.
absolutely brilliant when implemented properly. Excellent. Now that we've arrived at section 3, we'll discuss the recommended time frames for different trading styles, and we're beginning with swing trading, which I must say is an absolutely brilliant place for many traders to start their journey. So, what precisely are the recommended time frames for swing trading? Well, let me walk you through each component of this 3-tier system, and I think you'll find it rather sensible and well structured. Your higher time frame, and this is where everything begins, we're looking at either the 4-hour chart or the daily chart. Now these are highlighted in green here for very good reason. These are your primary time frames for establishing market direction. When you're swing trading, you're not looking to catch every little pip of movement. No, you're after the substantial swings in the market, and for that, you need the broader perspective that the 4-hour and daily charts provide. On these higher time frames, you're identifying the overall trend. Is the market bullish? Is it bearish? Are we in a consolidation phase? You're marking out your major support and resistance levels, significant order blocks, and fair value gaps. This is your foundation, your anchor point for all subsequent analysis. Now here's a particularly important note, and pay close attention to this. The 4-hour time frame is recommended as the absolute minimum for beginner swing traders. Why? Because it provides enough data to identify meaningful trends whilst simultaneously filtering out the market noise that plagues lower time frames. You see, on something like a 5-minute chart, you'll see every little wiggle, every minor fluctuation. It's rather overwhelming for a beginner. But on the 4-hour, the picture becomes much clearer, much more digestible. Moving on to your intermediate time frame. Here we're using the 1-hour chart, and this is where refinement takes place. You've identified your major zones on the 4-hour or daily chart, and now, on the 1-hour, you're looking within those zones for more precise areas of interest. Perhaps that large order block you spotted on the 4-hour actually contains a smaller, more potent order block on the 1-hour. Perhaps there's a fair value gap that provides additional confluence. This intermediate layer gives you that extra precision without overwhelming you with detail. And finally, your lower or entry time frame. Here we've got 2 options, the 15-minute or the 5-minute chart. This is where you're waiting for your entry triggers, your confirmation signals. Perhaps you're looking for a change of character on the 15-minute. Perhaps you prefer the finer detail of the 5-minute for your entry execution. Both work splendidly well. It really comes down to your personal preference and how tight you want your entry to be. Now let's consider why this particular configuration works so brilliantly for swing trading. You see, swing trading is about capturing moves that last several days to several weeks. You're not in and out within minutes. You're holding positions for a reasonable duration. Therefore, you need time frames that reflect that longer-term perspective. The 4-hour and daily charts give you that. They show you where the market has been over the past weeks and months, and they help you anticipate where it's likely headed next. But here's something I want to emphasize. Whilst these are recommended time frames, they're not set in stone. If you find that, for instance, you prefer using the daily chart as your higher time frame instead of the 4-hour, that's perfectly acceptable. The principle remains the same. You're still doing top-down analysis, still moving from broader to narrower perspectives. What matters is that you have a systematic approach and that you backtest thoroughly to ensure your chosen time frames work for your strategy. One more point worth mentioning. Swing trading is particularly well suited for those who cannot sit in front of their screens all day. If you have a full-time job, if you have other commitments, swing trading allows you to check your charts a few times a day rather than needing to monitor them constantly. That 4-hour chart isn't going to change dramatically every 5 minutes, is it? You have time to think, time to analyze, time to make measured decisions. So there you have it, your swing trading time frame configuration. 4-hour or daily for market direction, 1 hour for refinement, 15-minute or 5-minute for entries. A beautifully balanced system that provides comprehensive analysis without overwhelming complexity. Absolutely spot on for swing traders.
Right then, now let's examine what I consider to be the classic 3 time frame setup, the configuration for intraday trading. And this, my friends, is quite possibly the most popular time frame arrangement amongst day traders worldwide. What we're looking at here is the 4-hour, 15-minute and 5-minute combination. Now, this isn't just a random selection. This particular arrangement has been tested and proven by countless traders over many years. It strikes an excellent balance between comprehensive analysis and timely execution. Let's begin with your higher time frame, the 4-hour chart. Now, even though you're day trading, even though you're planning to close all your positions before the end of the trading session, you still need that broader perspective. The 4-hour chart provides exactly that. It shows you the overall market direction, the major swing points, the significant support and resistance levels. Think of it this way. If you're navigating through a city, you need to know which direction you're generally heading, north, south, east or west, before you worry about which specific streets to take. That's what the 4-hour chart does for your day trading. It tells you whether today is a day for looking for long opportunities or short opportunities. It shows you where the market has been over the past few days and where it's likely headed during your trading session. On this 4-hour chart, you're identifying your major points of interest, your order blocks, your fair value gaps, your supply and demand zones. You're noting where liquidity has been swept or where it still needs to be swept. This is your big picture view, and it's absolutely crucial for intraday success. Moving to your intermediate time frame, the 15-minute chart. This is where things become rather interesting. You've established your bias on the 4-hour, now you're dropping down to the 15-minute to identify specific setups. This is where you're refining those broader zones from the 4-hour chart. You're looking for more precise entry areas, for confluence factors that increase the probability of your trades. The 15-minute time frame is particularly brilliant for intraday trading because it's fast enough to catch intraday moves, but slow enough to filter out insignificant noise. You're not getting whipsawed by every minor fluctuation, but you're also not missing the significant intraday opportunities. It's that perfect middle ground. And finally, your lower or entry time frame, the 5-minute chart. This is where execution happens. You've done your homework on the 4-hour, identified your setup on the 15-minute, and now on the 5-minute, you're waiting for your entry trigger. Perhaps it's a candlestick pattern. Perhaps it's a break of structure. Perhaps it's a change of character. Whatever your specific entry criteria may be, this is where you're watching for it. Now, why is this particular configuration, 4-hour, 15-minute, 5-minute, so popular for intraday trading? Well, there are several reasons. First, it provides excellent coverage of the trading day. You can spot setups that develop over a few hours whilst still getting precise entries down to the 5-minute level. Second, it offers a proper balance of analysis and action. You're not spending hours analyzing multiple complex time frames, but you're also not jumping into trades blindly. You have 3 clear checkpoints: direction, setup, entry, each confirmed on its respective time frame. Third, and this is crucial, this configuration aligns beautifully with typical trading sessions. Whether you're trading the London session, the New York session, or the Asian session, these time frames will show you the relevant price action for that session, whilst also giving you context from previous sessions via the 4-hour chart. Now, let me share something from my experience. When traders struggle with day trading, it's very often because they're either trading too small a time frame, getting caught up in noise, or too large a time frame, missing the intraday opportunities. This 4-hour, 15-minute, 5-minute setup solves both problems elegantly. One more point worth emphasizing. Whilst this is called intraday trading, your analysis doesn't begin when the session opens. No, you're doing your 4-hour analysis before the session opens. You're identifying your key levels, your major zones, your bias for the day. Then, during the session, you're simply executing the plan you've already formulated. That's professional trading. Preparation before participation. This configuration has stood the test of time for very good reason. It works. It's comprehensive without being overwhelming, and it's fast enough for day trading whilst being slow enough to keep you out of trouble. Brilliant for sharp, short-term trades.
Right, now we're moving into what I consider the advanced territory, scalping timeframes. And I must be quite frank with you, this is not where beginners should start. This is fast-paced, intense, and requires considerable experience and mental discipline. Now, your higher time frame is the 15-minute chart. Your intermediate time frame is the 5-minute chart, and your lower or entry time frame is the 1-minute chart or possibly even tick charts if you're truly at the professional level. This is a completely different beast compared to swing trading or even intraday trading. Let's begin with your higher time frame, the 15-minute chart. Notice something crucial here. What we used as an entry time frame for intraday trading has now become our higher time frame for scalping. You're compressing your entire analysis into much shorter time horizons. On this 15-minute chart, you're establishing your immediate bias, not your weekly or daily bias, but your bias for the next hour or two of trading. You're identifying quick intraday swings, short-term supply and demand zones, immediate support and resistance levels. You're asking yourself, right now, in this moment, should I be looking for long setups or short setups? This is where you're refining your scalping zones. Perhaps you've spotted a small order block on the 15-minute chart. On the 5-minute, you're looking for the precise moment to strike within that zone, watching for confluence and additional technical factors that increase your probability of success. Finally, your entry time frame, the 1-minute chart or tick chart. This is where execution must be razor sharp. You're watching every single candle, every price swing, waiting for your specific entry trigger. If it appears, act immediately. Scalping is demanding. Frequent entries, impeccable risk management, intense concentration, and significant transaction costs all factor in. It's suitable for experienced, disciplined traders who thrive in fast-paced environments and who've proven themselves profitable on longer time frames. If you're new to trading, master swing trading first, then intraday. Scalping will still be there when you're ready. Remember, specific market conditions are essential for scalping's effectiveness. Fast, intense, and remarkably effective when mastered.
Excellent. Now we've arrived at section 4, where we'll explore higher time frame analysis in detail. And we're beginning with what I consider the absolute cornerstone, market structure. Now, when we talk about market structure on the higher time frame, we're identifying the overall trend by spotting major highs and lows. But it's not just about drawing random lines on a chart, is it? No, we're looking for specific structural shifts, breaks of structure, or BOS, and changes of character, or choach. Let me explain these concepts properly. A break of structure occurs when price decisively breaks through a significant high or low, confirming that the trend is continuing. Think of it like breaking through a ceiling or a floor. Once that happens, we have confirmation that the market intends to move further in that direction. It's a powerful signal of trend continuation. Now, a change of character, choach, is rather different. This signals a potential trend reversal or shift in market behavior.
Perhaps price has been making higher highs and higher lows in a bullish trend, but suddenly it fails to make a new high and instead breaks below a recent low. That's your change of character. The market is telling you, right, we might be changing direction here. Pay attention. You're also identifying major highs and lows. These are your key swing points that define the overall market structure and trend direction. These aren't minor fluctuations. These are significant turning points where the market has made meaningful decisions about direction. Now, here's something absolutely crucial. You must analyze both Type 1 and Type 2 structure. Type 1 gives you the overall macro trend, the big picture direction. Are we bullish? Are we bearish? That's Type 1. Type 2 shows you the current movement, what's happening right now within that larger trend. Perhaps Type 1 is bullish, but Type 2 is showing a pullback. That's valuable information for timing your entries. This dual structure analysis gives you comprehensive market context. You're not just looking at one perspective, you're understanding both where we've been over the longer term and what we're doing in the immediate term. That combination is remarkably powerful. When you're on your higher time frame, whether that's the 4-hour, the daily, or whatever you're using, take your time with this structural analysis. This is your foundation. Get this wrong, and everything else becomes significantly more difficult. Get this right, and your subsequent analysis flows naturally. Absolutely fundamental for directional bias.
Right then, let's discuss something absolutely fascinating and incredibly important: liquidity sweeps. And I must say, understanding liquidity is what separates amateur traders from professionals. So, what precisely are we looking for here? We're identifying areas where price has already swept liquidity. These are stop runs that have already occurred, or areas where liquidity still needs to be swept. And we're paying particular attention to both external and internal resting liquidity. Now, let me explain why this matters so tremendously. Markets don't just move randomly, do they? No, they move to collect liquidity. Institutional traders, the big players, the ones moving substantial capital, they need liquidity to execute their large orders. They cannot simply place a massive buy or sell order without moving the market drastically. So what do? They engineer moves to sweep areas where liquidity is resting. Where does liquidity rest? Well, it rests at obvious levels, above recent highs and below recent lows. You see, retail traders place their stop losses at these obvious points. If you're long, you put your stop below the recent low. If you're short, you put your stop above the recent high. Everyone does this, which means there's a pool of liquidity sitting there, waiting to be collected. External resting liquidity refers to stops sitting beyond the most recent swing highs or lows. Internal resting liquidity refers to stops within the current trading range. Both are important, but external liquidity sweeps often signal more significant moves because they represent the clearing of larger liquidity pools. Now, here's what's brilliant about liquidity analysis. When you see price sweep a liquidity zone and then reverse sharply, what's actually happened is the institutions have collected the liquidity they needed, and now they're ready to move price in their intended direction. You've essentially witnessed the market gathering fuel for its next move. So, on your higher time frame, mark out these liquidity zones. Where are the obvious highs that might get swept? Where are the obvious lows? Then, watch what happens when price approaches these areas. Does it sweep through and reverse? That's a potential trading opportunity. Does it respect the level without sweeping? That tells you something different. Perhaps the liquidity isn't needed yet, or the institutions aren't ready to move. This liquidity-focused approach transforms how you view charts. You're no longer just looking at support and resistance, you're understanding the mechanics of why price moves where it moves. You're seeing the market as a liquidity-seeking algorithm, which, quite frankly, is exactly what it is. Understanding liquidity sweeps also helps you avoid getting stopped out unnecessarily. If you know that price commonly sweeps a level before reversing, you can place your stops beyond where the sweep is likely to occur, rather than in the obvious spot where everyone else has theirs. Absolutely critical for professional trading.
Excellent. Now we arrive at points of interest, or POIs as we commonly call them. These are your key zones and levels where price is expected to react, and identifying them properly is absolutely crucial for successful trading. Now, what exactly are these points of interest? Well, you have several options, and the beauty of this is that you can use whichever methodology aligns with your trading style and what you've backtested successfully. First, we have order blocks. These are specific price zones where institutional orders were placed, causing a significant move away from that area. When price returns to an order block, there's a high probability it will react because there's likely unfinished business there, perhaps additional institutional orders waiting to be filled. Order blocks are particularly powerful when they align with other forms of analysis. Second, fair value gaps, or FVGs. These are price imbalances on the chart where price moved so quickly that it left a gap. The market has a tendency to return to these gaps to fill them, to achieve fair value. When you spot a fair value gap on your higher time frame, that's a potential point of interest where price might retrace before continuing its trend. Now, third, supply and demand zones. Now, this is rather classic technical analysis, but it remains relevant. These are areas where there was previously a significant imbalance between buyers and sellers, causing a sharp move away. The zone where that imbalance originated becomes a point of interest for future price action. Fourth, support and resistance levels. If you're more traditionally minded, these horizontal levels where price has historically respected certain prices can serve as your points of interest. The key is that you want levels that have been tested and proven meaningful, not just random horizontal lines drawn across your chart. And fifth, Fibonacci levels or confluence. Some traders prefer using Fibonacci retracement or extension levels, particularly when they align with other points of interest. The 61.8% retracement, the 1.618 extension, these are common targets. But here's my advice. Use Fibonacci as a confluence tool rather than your primary methodology. When a Fibonacci level aligns with an order block or fair value gap, that's when it becomes particularly powerful. Now, here's what's crucial to understand. The best trades occur when multiple points of interest align. Perhaps you have an order block that also happens to be a fair value gap, and it sits at a key Fibonacci level. That's what we call confluence. Multiple factors pointing to the same zone. Those are your highest probability setups. When you're analyzing your higher time frame, don't just mark every possible point of interest. Be selective. You want the key zones, the areas that genuinely matter, where institutional activity is likely to occur. Too many points of interest actually becomes counterproductive because you'll find yourself confused about which ones actually matter. Also, remember that points of interest are not precise price points, they're zones. Price might react at the top of the zone, the middle, or only at the very bottom. That's why we refine these zones on our intermediate and lower time frames before taking trades. Mark these carefully, annotate them clearly, and then watch how price behaves as it approaches them. Your higher time frame points of interest will become the anchor points for your entire trading strategy. These are your high probability reaction zones. Excellent. Now we arrive at points of interest, or POIs as we commonly call them. These are your key zones and levels where price is expected to react, and identifying them properly is absolutely crucial for successful trading. Now, what exactly are these points of interest? Well, you have several options, and the beauty of this is that you can use whichever methodology aligns with your trading style and what you've backtested successfully. First, we have order blocks. These are specific price zones where institutional orders were placed, causing a significant move away from that area. When price returns to an order block, there's a high probability it will react because there's likely unfinished business there, perhaps additional institutional orders waiting to be filled. Order blocks are particularly powerful when they align with other forms of analysis. Second, fair value gaps, or FVGs. These are price imbalances on the chart where price moved so quickly that it left a gap. The market has a tendency to return to these gaps to fill them, to achieve fair value. When you spot a fair value gap on your higher time frame, that's a potential point of interest where price might retrace before continuing its trend. Now, third, supply and demand zones. Now, this is rather classic technical analysis, but it remains relevant. These are areas where there was previously a significant imbalance between buyers and sellers, causing a sharp move away. The zone where that imbalance originated becomes a point of interest for future price action. Fourth, support and resistance levels. If you're more traditionally minded, these horizontal levels where price has historically respected certain prices can serve as your points of interest. The key is that you want levels that have been tested and proven meaningful, not just random horizontal lines drawn across your chart. And fifth, Fibonacci levels or confluence. Some traders prefer using Fibonacci retracement or extension levels, particularly when they align with other points of interest. The 61.8% retracement, the 1.618 extension, these are common targets. But here's my advice. Use Fibonacci as a confluence tool rather than your primary methodology. When a Fibonacci level aligns with an order block or fair value gap, that's when it becomes particularly powerful. Now, here's what's crucial to understand. The best trades occur when multiple points of interest align. Perhaps you have an order block that also happens to be a fair value gap, and it sits at a key Fibonacci level. That's what we call confluence. Multiple factors pointing to the same zone. Those are your highest probability setups. When you're analyzing your higher time frame, don't just mark every possible point of interest. Be selective. You want the key zones, the areas that genuinely matter, where institutional activity is likely to occur. Too many points of interest actually becomes counterproductive because you'll find yourself confused about which ones actually matter. Also, remember that points of interest are not precise price points, they're zones. Price might react at the top of the zone, the middle, or only at the very bottom. That's why we refine these zones on our intermediate and lower time frames before taking trades. Mark these carefully, annotate them clearly, and then watch how price behaves as it approaches them. Your higher time frame points of interest will become the anchor points for your entire trading strategy. These are your high probability reaction zones.
Now, let's examine Type 2 market structure, which focuses on current movement analysis. This is where things become rather interesting, because Type 2 gives you tactical timing within the strategic direction provided by Type 1. Type 2 structure analyzes the recent swings, the current market behavior, what's happening right now, rather than over the long term. You're looking at more recent highs and lows, typically over hours to days, rather than weeks to months. Why is this important? Imagine Type 1 structure tells you the market is bullish overall. Excellent. So we want to look for buying opportunities. But here's the thing. Price doesn't just go straight up, does it? No, it moves in waves, in swings, with pullbacks and consolidations. Type 2 structure helps you identify these shorter-term movements within the larger trend. So, in a bullish Type 1 market, if on Type 2 price is making lower lows and lower highs temporarily, that's a bearish Type 2 structure. Does this contradict Type 1? Not at all. What it's showing you is that we're in a pullback phase. The macro trend is still up, but currently we're retracing. This is actually excellent because it might provide an optimal entry point to join the larger bullish trend. Understanding how Type 1 and Type 2 interact is where the real skill comes in. When Type 1 is bullish, but Type 2 is temporarily bearish, you're potentially seeing a pullback that offers a buying opportunity. When Type 2 then shifts back to bullish, making higher highs and higher lows again, that's your signal that the pullback is complete and the trend is resuming. Type 2 is also valuable for counter-trend trading, though I must caution you, counter-trend trading requires considerable skill and discipline. If Type 1 is bullish, but Type 2 is showing a clear bearish structure, some advanced traders might take short-term short positions, riding that Type 2 bearish swing. But you must have strict rules about when to exit because you're trading against the macro trend. Advisingly, for most traders, particularly those developing their skills, I recommend using Type 2 primarily to time entries in the direction of Type 1. If Type 1 says bullish, wait for Type 2 to pull back and then resume bullishly. That's your entry signal. You're getting the best of both worlds, the high probability of Type 1 direction with the optimal timing from Type 2 structure. Now, Type 2 structure changes more frequently than Type 1. You might see several Type 2 shifts within a single Type 1 trend. That's perfectly normal and expected. Each Type 2 swing offers a trading opportunity, provided it aligns with your Type 1 bias. Use a different color scheme when marking Type 2 on your charts, perhaps blue for Type 2 bullish and orange for Type 2 bearish. This visual distinction helps you quickly identify the current short-term structure without confusing it with your longer-term Type 1 analysis. Concludingly, remember that Type 2 is about current movement, timing, and tactical entries. It's your short-term roadmap within the long-term journey defined by Type 1, brilliant for timing optimal entries.
Now let us delve into the fascinating world of combining Type 1 and Type 2 structures in actual practice. This is where theoretical knowledge transforms into practical trading prowess. Imagine, if you will, a classic scenario that many a trader encounters. Your Type 1 structure is clearly bullish, as evidenced by higher highs and lower lows on your extended time frame. The macro trend is unequivocally upward. Wonderful, isn't it? Yet, as we turn our attention to Type 2 structure, we observe a curious phenomenon. Price has been forming lower lows and lower highs in recent hours, or perhaps over a day or so. Type 2 reveals a bearish structure. But should we abandon our bullish outlook because of this? Perish the thought. What we are witnessing, my dear friends, is but a pullback nestled within the larger uptrend. Type 1 remains staunchly bullish, indicating that the overall direction persists upward. Type 2, in contrast, exhibits a temporary bearish nature, signaling a retracement phase, quite normal in market behavior, and indeed precisely what one should hope to see as it heralds opportunity. Consider the seasoned trader's approach. Firstly, they acknowledge the Type 1 bullish bias, resolute in their intention to seek only long positions. Resistance is futile against the macro trend. Secondly, they carefully observe the Type 2 bearish pullback, showing patience, biding their time for its completion. Finally, the awaited moment arrives as Type 2 shifts back to bullish with the emergence of a higher high or a breach of a recent short-term high. This transition from Type 2 bearish to Type 2 bullish is the coveted entry signal, a beacon guiding the way forward. Now, some advanced traders may choose a different path, opting to trade that Type 2 bearish pullback with short positions. However, and this is vital, they must follow stringent rules.
for such counter-trend trades bear greater risk. Swift profit targets, taut stop losses, and impeccable timing are their allies. But for most traders, especially those refining their consistency, counter-trend trading is best avoided. The odds are not in one's favor. Allow me another practical illustration. Type 1 presents as bearish, with its lower lows and lower highs. Meanwhile, on Type 2, the price begins charting higher highs and lower highs. What transpires here? We might be witnessing a relief rally embedded in a downtrend. Type 1 remains persistently bearish, maintaining the macro trend downward. Yet, should that Type 2 bullish structure persist and break through a meaningful Type 1 high, we might be on the verge of a Type 1 trend reversal. Major trend changes commence with Type 2 shifts, evolving into Type 1 adjustments. The artistry of combining these structures lies in grasping their hierarchical linkage. Type 1 offers strategic direction, while Type 2 provides tactical timing. Always honor the Type 1 bias, barring any definitive signs of a Type 1 transformation, such as a breach of primary structural levels. When Type 1 and Type 2 concur, both bullish or both bearish, those represent your most robust trading opportunities, with probabilities immensely in your favor through multi-horizon alignment.
Okay, so I wanted to sort of give you a little bit of a tiny walkthrough on Type 1 and Type 2 structure. If you haven't seen my video on intermediate to advanced market structure, you definitely need to take a look at it. But real quick, guys, when you are using the Fibonacci, right, specifically like this, right, you have only your 50% in the middle. The best thing to do and the best way to use it is if you see that market is in a downtrend, you want to wait for price to at least retrace to the 50% line to then and only then enter trades from the 50% or above in the premium area. Don't try entering trades going upward to the 50% line, because sometimes price doesn't always make it there. Wait for price to at least get there and wait for some kind of rejection on that same time frame that you're analyzing this on, or on a lower time frame, but try finding things like market structure shifts or changes in state of delivery, inverted fair value gaps, anything that indicates a change in the trend towards the downside. And then all of this also applies vice versa if you see that the trend is bullish, right? And as you can see in this example, price came up, tapped into the 50%, and then started rushing downward, right? That is something you have to keep in mind, especially when analyzing structure. So the Type 1 structure is essentially the overall structure that you're seeing here, whether it's on this time frame or a higher time frame, right? So that's what it would look like. And as you can see here, we'll pull up the fib here again, down to here, barely makes it to the 50%. And if I go here, guess what? You could have also entered a short somewhere around this premium down to the 50%, or you could have kept going lower until price ended up inevitably retracing back up again into the premium area here to continue moving downward. You're not always going to catch them all, as you can see here, especially if you were someone that's trying to short long term to this bottom area down here, right? Why? Price will just do what it wants to do at the end of the day. But at least you have a higher probability of actually winning your short positions, as opposed to going and entering long and then losing more on the long positions, right? But again, this is just trading with the trend, guys. Let me show you another example here. Okay, the trend is bullish. We set up the fib here. Price came down to the 50%, or if it would have came down a little lower, you would have then entered trades, right? You would have entered trades to go long. Okay, but you, again, be very careful, guys. Always trade like this. Okay, don't trade like this. Enter here and then bam, right? One big old trade. No, don't do that. Enter small little trades, guys, like that. Scale in from the lower time frame, right? Find setups on the lower time frame. 1, 2, 3 wins, as opposed to just trying to do this right here right? You're entering, try to go long. Great, you have one big win. And then the next time you enter again, which would be, let me see, from here, let's say you adjust it again, right? Let's say you're adjusting it again for the new trend that's just got set up. You enter here again, stop loss under here, right? Let's just say you're trying to put it like somewhere near here. You're trying to target again this big, all these pips. Guess what? You just lost all of your money. Okay, that's why you want to do little by little by little, right? You want a good, decent little risk to reward with a good bit of wins, so that when you do lose, you don't lose too much, and then you still you get to keep most of your profits, right? That's how I want you to view it. Okay, so just remember, anytime you're trading in an uptrend, wait for price to come down to the 50% or lower in a discount, and anytime you're trading from a bearish market, you want to make sure price comes to the 50% or to the premium and enter shorts only. That's if you're using the fib. Okay, so just keep that in mind. And again, take a look at my intermediate to advanced market structure video. It's going to help a lot with type 1 and type 2 structure and a couple of other things.
Excellent. We've now arrived at section 6, intermediate time frame analysis. And we're beginning with what I consider absolutely essential, refining your points of interest. Now, you've already done the heavy lifting on your higher time frame, haven't you? You've identified the overall trend, marked out your major points of interest, perhaps order blocks, fair value gaps, supply and demand zones. Brilliant! But here's the thing. Many of these zones can be rather large, can't they? And trading from an excessively large zone can be problematic. Let me explain why refinement is so crucial. Imagine you've identified a significant order block on the 4-hour chart that spans, let's say, 60 pips. Now, if you simply wait for price to touch the top of that zone and immediately enter a trade, what might happen? Well, price could continue moving against you for quite some distance before actually reacting. You see, the true institutional interest might be concentrated at the bottom portion of that zone, not the top. This is where your intermediate time frame becomes absolutely invaluable. You drop down, perhaps from the 4-hour to the 15-minute, and you examine that large order block more closely. What do you see? Perhaps there's a smaller, more concentrated order block nested within the larger one. Perhaps there's a fair value gap that provides additional confluence. Perhaps there's a specific liquidity sweep that occurred at a particular level. By refining your zone, you're essentially narrowing down the area where institutional activity is most likely concentrated. Instead of a 60-pip zone, you might refine it down to a 20-pip zone or even smaller. This refinement provides several crucial benefits. First, tighter stop losses. If you know the precise area where price should react, you can place your stop loss just beyond that refined zone rather than beyond the entire large zone. This dramatically improves your risk-to-reward ratio. A 20-pip stop versus a 60-pip stop, that difference compounds significantly over dozens of trades. Second, higher entry precision. By entering from a refined zone, you're getting into the trade at a more optimal price. You're not entering early and suffering unnecessary drawdown. You're entering when price has reached the actual area of institutional interest. Third, increased confidence. When you've done the work to refine your zones properly, you trade with greater conviction. You're not second-guessing whether you should wait for price to move deeper into the zone. You know exactly where your entry should occur. Now let me share a practical tip. When refining zones on your intermediate time frame, look for multiple factors aligning. Perhaps your refined order block also aligns with a Fibonacci level. Perhaps it coincides with a previous minor support or resistance. These confluences within your refinement add additional layers of probability to your setup. Also, pay attention to how price has historically reacted to this zone on lower time frames. Has it consistently bounced from the top portion, or does it tend to wick into the lower portion first? This historical behavior can guide you refinement process. But here's a word of caution. Don't over-refine. There's a point of diminishing returns where you're zooming in so tightly that you're essentially just guessing. The goal is to make your zone actionable and precise, not microscopically perfect. A balance is required. Professional traders find that sweet spot through experience and backtesting. Remember, refinement is about making your analysis actionable. It's about transforming broad zones from your higher time frame into precise trading areas on your intermediate time frame. This is what professional preparation looks like, absolutely essential for precise entries.
Right then. Whilst refinement is crucial, there's another equally important function of your intermediate time frame. Finding additional points of interest and structure that weren't immediately obvious on the higher time frame. You see, when you're looking at a 4-hour chart, you're seeing the major swings, the significant levels. But within those major swings, there's an entire world of smaller scale structure that the higher time frame simply doesn't reveal. Your intermediate time frame, perhaps the 15-minute or 1 hour, shows you this hidden structure. Let me give you a practical example. On your 4-hour chart, you've identified that price is moving from point A to point B, perhaps from one order block to another. Excellent. You know the probable destination. But how will price get there? Will it move in one clean sweep? Or will there be intermediate levels where price might pause, consolidate, or even retrace temporarily? This is where dropping down to your intermediate time frame becomes fascinating. Suddenly, you see additional structure within that larger move. Perhaps there's a smaller order block midway between your higher time frame points. Perhaps there's a fair value gap that price might fill before continuing. Perhaps there's a liquidity pool at a specific level that needs to be swept. These additional points of interest serve multiple purposes. First, they provide alternative entry opportunities. Perhaps you missed the initial entry at your higher time frame point of interest. Not to worry, these intermediate levels give you additional chances to join the trend. It's rather like catching a train, isn't it? If you miss it at the first station, there are subsequent stations where you can still board. Second, these intermediate points help you manage existing trades. If you're already in a position, these levels can serve as partial profit targets. You might take some profits at an intermediate level whilst leaving the remainder to run toward your final higher time frame target. This is sophisticated trade management. Third, they provide context for price action. When price pauses at one of these intermediate levels, you're not confused about why. You've already identified it on your intermediate time frame. You understand that price is simply reacting to that level before continuing toward your ultimate target. Now, here's something I want you to pay particular attention to. Look for support-turned-resistance or resistance-turned-support levels on your intermediate time frame. These role reversal levels are remarkably powerful. Perhaps price broke above a level on its way up. When it retraces, that broken resistance often becomes support. These levels provide excellent confluence when they align with other points of interest. Also, watch for smaller-scale liquidity sweeps on your intermediate time frame. These micro sweeps can provide entry opportunities that the higher time frame doesn't show. Perhaps there's a small cluster of equal highs on the 15-minute chart. When price sweeps those highs and reverses, that could be your entry signal. The key skill here is balancing the higher time frame bias with the intermediate time frame structure. Your higher time frame tells you the overall direction. That's your strategic bias. Your intermediate time frame shows you the tactical path price is likely to take. Together, they give you a complete roadmap. But I must caution you, don't let intermediate time frame structure distract you from your higher time frame bias.
These additional points of interest are meant to enhance your analysis, not contradict it. If your higher time frame says bullish, you're using intermediate structure to find optimal long entries, not to justify shorting against the trend. Finding these additional layers of structure separates good traders from great ones. It's about seeing the complete picture at multiple scales simultaneously. Increases precision for optimal execution. Excellent! We've now arrived at Section 7, Entry Time Frame Analysis. This is where all your preparation culminates in actual trade execution. We're beginning with entry confirmation signals, and I must stress this is absolutely critical to your success. You see, many traders make a fatal mistake. They've done brilliant analysis on their higher time frames. They've identified perfect setups, but then they enter trades prematurely without proper confirmation. And what happens? They get stopped out just before the trade would have worked. Devastating, isn't it? Confirmation signals are your final safety check. They're what separate hopeful gambling from professional trading. So, what precisely are these signals? Let me walk you through the primary ones. First, we have candlestick confirmation. This is classic technical analysis, but it remains relevant. You're looking for specific candlestick patterns that indicate a reversal or continuation. Perhaps an engulfing candle, where a single candle completely engulfs the previous candle's body. Perhaps a pin bar or hammer showing rejection from a level. Perhaps a doji indicating indecision followed by a strong directional candle. The key with candlestick patterns is context. A pin bar at a significant order block on your entry time frame aligned with your higher time frame bias, that's meaningful. A random pin bar in the middle of nowhere, not so much. Context is everything. Second, change of character or church. This occurs when price action on your entry time frame shows a shift in behavior. Perhaps price has been making lower lows in a pullback, but suddenly it breaks above a recent high. That change of character signals that the pullback might be complete and the trend is resuming. It's your green light to enter. Third, break of structure or boss. This is when price decisively breaks through a significant level on your entry time frame, confirming the continuation of the trend. Perhaps you're waiting for a bullish trade and price breaks above a short-term high on your 5-minute chart. That break of structure confirms that buyers are now in control and it's safe to enter. Fourth, liquidity sweeps. This is rather sophisticated but tremendously powerful. Price sweeps above or below a level to collect liquidity, triggering stops, and then immediately reverses. That sweep and reverse pattern is often your optimal entry signal. The institutions have collected the liquidity they needed, and now they're ready to move price in their intended direction. Fifth, state of delivery or order flow. This involves reading the character of the candles themselves. Are you seeing strong, decisive candles in the direction of your trade? Or are you seeing weak, hesitant price action? Strong delivery in your trade direction provides additional confirmation. Now, here's what's crucial to understand. You don't necessarily need all of these signals simultaneously. That would be rather impractical. What you need is your specific entry criteria clearly defined in your trading plan. Perhaps your rule is enter when price taps my refined zone and gives me either a choke or an engulfing candle. That's specific, that's measurable, that's actionable. The worst thing you can do, and I see this constantly with struggling traders, is to enter simply because price has touched your zone. That's not a confirmation, that's hope. You must wait for price to show you that it's ready to reverse or continue. Patience at this stage is absolutely essential. Also, consider the timing. Are you getting your confirmation signal during a high volume period or during the Asian session doldrums? Are you in a kill zone, a period of high institutional activity? These timing factors add additional weight to your confirmation signals. Remember, confirmation is not optional. It's the final filter that keeps you out of low probability trades. Wait for it, watch for it, and only then commit your capital. Never enter without proper confirmation.
Right then, let's discuss entry criteria and target selection, the final pieces of your trading puzzle. And I must say, getting these elements right is what separates consistent profitability from frustrating mediocrity. Let's begin with stop-loss placement. This is your safety net, your risk management cornerstone. Where precisely should your stop-loss go? Well, it should be placed outside your refined pointed interest, not at the edge of your zone, but beyond it, giving price room to breathe while still protecting your capital. Here's the principle. If price moves beyond your refined zone and takes out your stop, it's telling you something important. Your analysis was incorrect or the setup has failed. You want to be stopped out in those scenarios. That's not a failure, that's proper risk management. Many traders make the mistake of placing stops too tight, trying to minimize their risk per trade. But what happens? They get stopped out by normal price fluctuations, only to watch the trade work perfectly afterwards. That's devastating, isn't it? Give your trades appropriate breathing room based on the volatility of the instrument you're trading. Now, regarding entry itself, precision matters tremendously. Are you entering market orders the moment you see confirmation, or are you using limit orders placed at optimal levels within your zone? Both approaches work, but each has implications. Market orders guarantee execution, but might give you suboptimal prices. Limit orders give you perfect prices, but might not get filled. Know which approach suits your strategy. Moving on to first target selection. This is crucial for beginners especially. Target the nearest structure or liquidity on your entry time frame. Don't be greedy. If there's a fair value gap or order block 30 pips away, target that first. Secure some profit, reduce your risk, and then consider letting the remainder run. Why? Because taking partial profits serves multiple purposes. First, it locks in gains. You're guaranteed to be profitable on that trade. Second, it provides psychological relief. Trading is stressful. Partial profits ease that stress. Third, it allows you to move your stop to break even on the remaining position, making it risk-free. For more experienced traders, you might target your intermediate or higher timeframe points of interest. If you've done comprehensive analysis and your setup is high conviction, reaching for those larger targets is perfectly appropriate. But, and this is crucial, you must have proven to yourself through backtesting that your strategy can achieve those targets consistently. Here's a sophisticated technique: scaling out. Perhaps you take 1/3 of your position off at your first target, another third at your second target, and let the final third run towards your ultimate target. This approach balances the certainty of smaller profits with the possibility of larger gains. Rather elegant, actually. Now, moving stops to break even. This is a topic of some debate, but I'm firmly in favor of it for most traders. Once price has moved significantly in your direction and you've taken partial profits, move your remaining stop to break even. Why? Because now you're trading with house money, so to speak. You cannot lose on this trade anymore. The psychological freedom this provides is remarkable. Some traders argue that moving to break even too early causes unnecessary stop-outs. That's a valid concern. The solution? Only move to break even after price has moved beyond a significant level in your direction. Perhaps after it's broken through an intermediate structure or collected a liquidity pool. Use price action milestones, not arbitrary pip counts. One more critical point.
Have your targets identified before you enter the trade. Don't be scrambling during the trade trying to figure out where to take profits. That's reactive trading, and it leads to emotional decisions. Professional traders know their targets before they even click the entry button. Your entry criteria and targets should be written down, part of your trading plan, tested through backtesting and followed religiously. No exceptions, no hoping, no emotional adjustments mid-trade. This discipline in execution separates professionals from amateurs. Precision in execution determines profitability.
Excellent. We have now arrived at Section 8, Common Questions. And I must say, these are queries I receive constantly from traders at all levels. Let's begin with a question everyone asks. What are the best pairs and markets to trade? Now, I'm going to give you an answer that might initially disappoint you, but it's the honest truth. There is no universally best pair or market. These top-down analysis concepts apply to any instrument you choose to trade. Whether you're trading Forex, futures, cryptocurrency, or even equities, the principles remain exactly the same. However, and this is important, whilst the concepts are universal, not all instruments are created equal in terms of trading characteristics. Some instruments are more suitable for particular strategies and trader personalities than others. Let's discuss Forex first. Within the Forex market, I generally recommend focusing on the major pairs, particularly GBP-USD, the cable as we call it. Why GBP-USD specifically? Well, it has several characteristics that make it rather attractive for retail traders. First, it's highly liquid. There's always someone on the other side of your trade. Second, it moves well. It has enough volatility to provide trading opportunities without being excessively chaotic. Third, it has clear institutional participation, which means your higher time frame analysis tends to be respected. Other major pairs like Euro-USD, USD-JPY, AUD-USD, these are all perfectly tradable as well. The key is liquidity and predictable behavior patterns. Avoid the exotic pairs unless you really know what you're doing. Those pairs can be erratic and expensive to trade due to wide spreads. Moving to futures markets. Here, the NAS 100, the Nasdaq futures, and the US 30, the Dow Jones futures, are tremendously popular among retail traders, and for good reason. They offer excellent liquidity, clear trends, and they respond beautifully to technical analysis. The moves can be substantial, providing significant profit potential for those who trade them properly. However, I must caution you, futures contracts have different characteristics than Forex. They are typically more volatile, they move faster, and they require more capital due to contract sizes and margin requirements. Make absolutely certain you understand these differences before trading futures. Transitioning to cryptocurrency with cautionary enthusiasm. Cryptocurrency is another market that's gained enormous popularity. Bitcoin, Ethereum, and other major cryptocurrencies can certainly be traded using top-down analysis. However, crypto markets can be extraordinarily volatile. They trade 24/7, which can be exhausting, and they're more susceptible to sudden news-driven moves. If you choose to trade crypto, risk management becomes even more critical. Now here's my central point. Regardless of which market or pair you choose, you must backtest your strategy specifically on that instrument. Different pairs have different personalities, different average daily ranges, different behavior patterns. What works brilliantly on GBP-USD might not work at all on USD-JPY. You need data, historical data showing that your approach is profitable on your chosen instrument. Start with one instrument and master it completely. Don't be a jack of all trades, master of none. Pick your battleground, study it intensively, trade it consistently, and become an expert on that specific market's behavior. Also, consider practical factors. What are the spreads on your chosen pair? What's the commission structure? When is that market most active? These seemingly minor details compound significantly over time. The final truth, delivered with resolute clarity. The best market is the one you've back-tested thoroughly, understand deeply, and can trade during your available hours. That's the honest answer, and whilst it requires work, it's the path to consistent profitability. Persuasive closing line with strategic advice. Backtest everything before committing real capital.
Right then, another frequently asked question. What are the best time frames for identifying points of interest and taking entries? And once again, I must give you the nuanced answer. There's no perfect time frame that works for everyone. You see, different traders have different strengths. Some traders are absolutely brilliant at reading price action on lower time frames, the 5-minute, the 1-minute. They can spot patterns quickly, make rapid decisions, and execute with precision. Other traders find lower time frames chaotic and overwhelming. They need the clarity that higher time frames provide. It's rather like asking whether a hammer or a screwdriver is the better tool. Well, it depends entirely on what you're trying to build, doesn't it? Similarly, the optimal time frame depends on your trading style, your schedule, your personality, and your experience level. However, and this is helpful, I can give you some guidance based on what I've observed works well for different trader categories. For identifying points of interest, many traders find the 4-hour chart to be something of a sweet spot. It's high enough to filter out noise and show meaningful structure, yet low enough to provide actionable trading opportunities within a reasonable time frame. On the 4-hour chart, you can clearly see major order blocks, significant fair value gaps, and key supply and demand zones. The structure is obvious. You're not drowning in detail, but you're not so zoomed out that opportunities become rare. For beginners especially, starting with the 4-hour for bias and POI identification is excellent advice. For entries, the picture changes somewhat. The 15-minute and 5-minute charts are tremendously popular for entry execution, and with good reason. These time frames provide enough detail to time your entries precisely, whilst still being slow enough that you're not getting whipsawed constantly. The 15-minute is particularly useful if you prefer slightly longer holding periods, perhaps several hours to a full trading day. The 5-minute is better if you want tighter entries and are comfortable with faster price action. Both work splendidly well. It's genuinely a matter of personal preference. Now, here's something crucial I want you to understand. Your optimal time frame configuration will likely evolve as you develop as a trader. When you're beginning, you might need those higher time frames for clarity. As you gain experience, you might find yourself comfortable operating on progressively lower time frames because you've developed the pattern recognition skills necessary. I've seen traders start with daily, 4-hour and 1-hour configurations, and years later they're trading comfortably on 15-minute, 5-minute and 1-minute setups. Both approaches can be profitable. It's about matching the time frames to your current skill level. Here's my practical recommendation. Start where you can clearly see structure and feel comfortable with the pace. If the 4-hour makes sense to you visually, if you can identify the patterns, if you're not feeling overwhelmed, start there. If you need to go even higher to the daily chart, that's perfectly fine. There's no shame in trading higher time frames. In fact, many professional position traders exclusively use daily and weekly charts. For entries, don't feel compelled to trade the 1-minute chart just because some YouTube trader does it. If the 15-minute gives you clarity and your backtesting shows it's profitable, stay there. Simpler is often better.
The key is experimentation backed by data. Try different time frame combinations, backtest them thoroughly, and let the results tell you what works for your trading personality. And remember, consistency matters far more than which specific time frames you use. Master one configuration completely, rather than constantly switching between different setups hoping to find the magical combination. Your optimal time frame matches your trading personality.
Excellent. Now, this is perhaps the most important slide in this entire section. Recommendations specifically for beginners. And I want you to listen carefully, because following this advice could save you months or even years of frustration. If you're just starting your trading journey, here's my straightforward recommendation. Use the 4-hour chart for establishing your bias, the 15-minute chart for identifying and refining your setups, and the 5-minute chart for your actual trade entries. Simple, clear, and proven. Why this specific configuration? Let me explain. The 4-hour chart is high enough that you're seeing meaningful market structure without getting overwhelmed by noise. You can open your charts once or twice per day, do your analysis in a relaxed manner, and identify your potential setups for the upcoming session. You're not glued to your screen constantly. You have time to think, to analyze properly. The 15-minute chart gives you that intermediate layer where you refine your 4-hour points of interest and identify more precise entry zones. It's fast enough to catch intraday opportunities, but slow enough that you're not making 50 decisions per hour. For someone learning to trade, this pace is manageable. And the 5-minute chart for entries gives you precision without overwhelming speed. You can watch for your confirmation signals, execute your entry, set your stop and target, and then step away. You're not trapped in front of your screen watching every tick. But here's what I really want to emphasize. Don't jump to lower time frames until you're consistently profitable on these. I see this mistake constantly. Beginners start on the 4-hour, achieve some initial success, and then think, right, if I drop down to the 1-minute chart, I'll get more opportunities and make money faster. Disaster inevitably follows. Lower time frames are not easier, they're harder. They require faster decision-making, better emotional control, and more experience reading price action. Master the 4-hour, 15-minute, 5-minute configuration first. Prove to yourself with real data that you can be consistently profitable. Only then consider faster time frames. Now, let's talk about backtesting, and I cannot stress this enough. Before you risk a single penny of real capital, you must backtest your strategy thoroughly. Go back through months of historical data on your chosen time frame configuration, mark out your setups, identify where you would have entered, where you would have placed stops, where you would have taken profit. Record everything. Keep a detailed log. Calculate your win rate, your average risk-to-reward ratio, your drawdown periods. Only when you have statistical proof that your strategy works should you consider live trading. And even then, start with the absolute minimum position size. Keep it simple. This is another crucial point for beginners. Don't try to incorporate 10 different indicators, 5 different types of analysis, and 3 different trading strategies simultaneously. Focus on clean price action, clear market structure, and the top-down methodology we've discussed. Master the fundamentals before adding complexity. Also, understand that consistency develops over time. You're not going to master this in a week or even a month. Give yourself at least 6 months of consistent practice before you evaluate whether trading is for you. Most beginners quit far too early, right before they would have started seeing results.
One final recommendation. Trade the London or New York sessions initially. These are the highest liquidity periods where price action tends to be cleaner and more predictable. Avoid the Asian session unless you're specifically targeting that market. And please, protect your capital above all else. Use proper position sizing. Risk no more than 1% of your account per trade when you're beginning. Preserve your capital so you can continue learning and improving. This foundation sets you up for long-term success.
Alright, so for this example, we are going to use NAS 100, starting off with the 4-hour. Now, I will keep it very simple for this example and the next ones. Now remember guys, you can use literally anything, whatever concept you're using, you can use it for your top-down analysis. Alright, keep in mind again that this video is like a bank that stores a bunch of information, and you can use that information however you want to make your form of top-down analysis. But like I said, I'm gonna try keeping it very simple. So with NAS 100, these last 4 hours, right? What we have seen for the past few days is price has been pretty bearish, right? Bearish here, bearish here, bearish here, and then we actually have a break of structure right here. So I have no reason to believe that we are going to change trend any other moment or at any other time. For now, I am pretty bearish, okay? And so the other thing too is, notice how price quickly swept that liquidity, then came back up, right? So that means that we're going to the upside temporarily to possibly only sweep some liquidity, which we did have here. And what happened? Price slightly went over it, quickly rejected, and we're just gonna wait a little bit more, see what we get. Bam, a really big bearish candle, meaning that we are very likely not going to continue going back up. Right now, there are the reasons to assume that price will continue moving downward because of all the fundamentals and stuff like that that support the idea that we really just had to sweep some liquidity here to continue going down to external range liquidity. So what is the liquidity that we're probably going to target? This right here, more than likely something like this, right? Some gaps right here, right? So with that, now we can go to the 15-minute time frame. Now with the 15-minute time frame, let's see where price is gonna go to use as fuel to continue going down to this external range liquidity. Well, you can see here we have a 15-minute fair value gap, right? We have that 15-minute fair value gap here. So that means that at some point price is going to come up into this fair value gap and then shoot back down. So we're gonna go down now to this 5-minute time frame. Now what I want to see a reason to enter into a trade to go downward, right? I need to see the trend shift back down. So I need something that indicates that to me pretty quickly. But it also has to tap into that fair value gap while doing so. So will that price play out? Right, not yet. Okay, so price finally taps into that 15-minute fair value gap. Now we need to see something that says, hey, I'm ready to move downward, so that way we can enter into a trade. So either I get a change in state of delivery or some kind of inversion. I'm probably gonna look for a change in state of delivery here. Okay, so we finally got that here. Stop loss here. I can either put my stop loss here or at the end of this fair value gap. I'll probably just leave it somewhere up here, and then we can target this set of liquidity down here. Let me see if I can get this to move a little bit quicker. I'll just return. Okay, so finally price ended up hitting TP, right? But you see guys, it's very simple. Again, there are many other ways to use top-down analysis. I will give you guys another example just so you guys can sort of get it solidified in your mind. Okay, so for this example, I am going to use natural gas. Now, starting off with the monthly time frame, this is specifically meant to help out with framing a weekly analysis and just giving a general assessment of the asset itself. So what can we tell about the asset? Well, fundamentally seems to be pretty bullish. Why? Because it had a break of structure here. Price has not been able to break past this order block, and we had another breakup structure towards this high right here, and hasn't broken away since. And we also see that price formed a low here, and the obvious thing that it would do now is go take out this high at some point. So we can drop now down to the 4-hour time frame. Now remember guys, with pitch fans, this is more as like sideways support and resistance levels that are meant for more of a long-term view of where price is going to go. Okay, so what can we see here? Price is pretty bullish, right? And if we let price play out, you'll see that it does a pretty good job at respecting these areas as some kind of form of support or even resistance. Look how it wicked away from this line right here, right? And if you go back, you'll find some kind of sweep of liquidity or some kind of order block or fair value gap that it taps into, but it also aligns with the pitch fan line. So let's keep letting price play out. Finally, price rejects. As you can see here, price just makes this big wick, and then what does it end up doing? Starts moving towards the upside, right? And respects the fan line really well. And what do you find here? You also find an order block in this area that overlaps with this line. And what does the line do? Takes out more external range liquidity on the 4-hour, right? So that's one way that you can use 2 time frames to also give you a overall analysis and picture of the asset itself, where it's going to go, the liquidity that it's seeking, so on and so forth. Now I'm going to give you one more example, and again guys, there's many ways to do top-down analysis. So one more. All right, okay, so for this example I will be using the 5-minute time frame for my entire analysis. All right, so we're going to keep it again very simple here. So what do we see already? We already see price touching this order block right here. Seems to be respecting it pretty well. It's filling in the fair value gaps that are inside this order block. It's just been a couple of wicks, and it also inverted this fair value gap right here, and it seems to be respecting it pretty well, right? Okay, so what does that mean that price is going to end up doing? Inevitably is taking out this liquidity here, this liquidity here, right? We can already tell that price is bullish because of the breaks of structure here and the breaks of structure up here, and the fact that it filled up all of this liquidity, all of this, and still kept moving upward lets me know that we are definitely bullish for this upcoming session. So now what we just got to do is find an entry and target some liquidity. That's a pretty big candle. You know what? I'll enter here. Stop loss down here. And we're going to try targeting that liquidity. Perfect. Now, obviously, guys, I cherry pick my examples like I've said. This just to illustrate my points exactly. Now, I know that in the presentation, I've said that you can refine order blocks if you want to, but that isn't always necessary. You can, but it's up to you. It's usually best to refine them if you're doing something like a weekly analysis or an analysis on the entire pair fundamentally, you know, to determine where it's going to go in the long term in the next couple of years or the next couple of months, and sometimes even the next couple of weeks. But again, I'm trying to keep it all very simple for you guys to show you that you don't need to complicate it. So with that being said, I got one more example for you, so let's hop on to that. Alright guys, so for this example I will be using coffee. Yes, you guys can use top-down analysis on literally anything. So we're going to start off with the 15-minute time frame. Now we're going to try to keep it pretty basic and pretty simple. We're just going to try using fair value gaps, order blocks, and liquidity. Alright, so what do we see here already on the 15-minute time frame? We already see this big fair value gap being filled and having a hard time breaking through it. Why? Because we see this big wick here and we see pretty big wicks here, right? And price was starting to stagger pretty badly. The more it started approaching this fair value gap, it's basically a consolidation, but towards the downside. Okay, cool. What else can we see here? Well, we also have an order block down here. So we have that. This would be a demand, and look how perfectly it taps into that demand. Now, since we are going to head to this external range liquidity, why? Because remember guys, we are bullish on the 15-minute time frame, or at least from what we can see on recent price action, right? Same thing here and same thing here. Okay, so we're pretty bullish. All right, so now let's go down to the 5-minute time frame. Now on the 5-minute time frame, we can also try finding for smaller bits of liquidity that we can also use to try to scalp our way up safely and maybe find some re-entries, things like that. So right off the bat, I can already tell you this is going to be a good bit of liquidity here to target, liquidity here, here, all this liquidity here, right? Now let's go down to the 1 minute and again find some kind of change in the trend that says, hey, we're going to go back up to try to get some liquidity. So maybe we'll look for some inverted fair value gaps, market structure shifts, changes in state of delivery, things like that. So we actually got a change in state of delivery here. Obviously you want to have a trading plan, guys. Don't just make it up as you go. So we're going to enter here. And obviously guys, all of this is in hindsight. I'm not going to lie to you. I do cherry pick my examples, but that is only to illustrate what I am talking about here. Nothing is 100% certain or perfect. Okay. And so we're just going to target this right here. Gonna let price play out. Bam, TP right there. And again, guys, we have all this liquidity that we're going to target. So we already know that the trend is shifting. Let's try to see if we can get into another entry. Price came down, filled some fair value gaps down here. Let's see if we can get into another change in state of delivery. I want to enter here. That's really what I'm looking for. That's what I want. Okay, I would have obviously entered here. Stop loss right under here. And not too greedy, just go to like a 1 to 2. Bam, TP again. So as you can see guys, many ways of using and doing top-down analysis, using many forms like ICT, pitch fans. You can even use trend lines, all kinds of stuff. Just make sure you back test every single thing that you do, everything that you're learning. Don't just live test it on the markets, okay? I will be releasing plenty more videos on how to use different strategies for daily bias, different ways to get bias for the week, the month, analyzing assets, all that good stuff. But for now, guys, this is really all you need to be successful, okay? So with that being said, let's move on.
Right then, we have arrived at a pivotal moment in our trading journey, one that I believe can fundamentally change your approach to the markets. The title of this slide boldly states, there's no one way to do top-down analysis, and it's crucial that you truly grasp the significance of this. Throughout this presentation, I've laid out a systematic framework, higher time frames for bias, intermediate ones for refinement, and lower ones for execution. This structure is, without question, solid. However, what's absolutely vital to comprehend is this: the specific tools you employ within that framework are utterly flexible. They're options, not dictates. Top-down analysis is simply a workflow, a process of moving from the macro down to the micro. That's the framework. But the tools you choose to identify your macro bias, mark your levels, and trigger your entries, these are choices from a vast array of possibilities, not hard rules set in stone. Consider this. If I were to ask 10 successful traders to demonstrate their top-down analysis, I would see 10 unique approaches. One might employ ICT concepts, internal and external range liquidity, fair value gaps and order blocks. Another might utilize Fibonacci techniques, retracements, fans, harmonic patterns. A third might adhere to Wyckoff methodology with its accumulation and distribution phases, springs and upthrusts, while another could harness Elliott wave theory with its impulse and corrective structures, while a fifth might rely solely on price action, support and resistance, candlestick patterns. Remarkably, each of these traders can be profitable. Each approach is valid. They are all systematic solutions to the fundamental question, where is the price heading and when should one enter? Why? Because they are unique lenses through which to view the same raw material price, time, volume, and liquidity. No framework encompasses everything. Each highlights certain patterns while disregarding others, and that's perfectly acceptable. The critical factor isn't which lens you select, it's whether you can consistently execute your chosen lens and whether your data demonstrates its edge. Examine the examples herein: ICT and smart money concepts with their liquidity-centric approach, the Fibonacci suite, grounded in mathematical ratios, Wyckoff with its insights on accumulation and distribution, Elliott wave with its fractal wave structures, and pure price action, focusing on raw support, resistance, and candlestick patterns. Technical indicators and profile tools follow moving averages, RSI, MACD, VWAP, volume profile, Bollinger Bands, pivot points. Order flow analysis and volatility measures such as ATR round out the list. Each of these methods is a legitimate avenue to organize your top-down analysis. Each could be profitable when wielded by a trader who has meticulously tested it. But here's the paramount principle to keep in mind. Utilize what you can consistently execute and what your data substantiates as having an edge. Not what looks appealing in a YouTube video, not what is fervently endorsed by your favorite trading guru, not what sounds sophisticated or intricate. What you can execute consistently, meaning you can adhere to the rules without emotional disruption day after day, and what your data validates as effective, meaning you've back-tested it, you forward-tested it, you possess statistical evidence of its efficacy. And isn't that liberating? You're no longer on a quest for the one true method. You're experimenting, testing, discovering what resonates with your persona, your timetable, your risk tolerance, and your cognitive strengths. Some traders shine in deciphering complex institutional flows, others excel in spotting geometric placements, while some exhibit extraordinary patience in waiting for perfect Wyckoff springs, while those thrive on swift indicator-based triggers. There's ample room for every approach. The market is vast, liquid, and perpetually offering opportunities through a multitude of lenses. Your task isn't to identify the objectively best method, it's to discern your method, the one that suits you, that you trust, and that your data validates. Moving forward into subsequent slides, I'll exhibit several valid workflows, modular building blocks to combine, and a pragmatic framework for testing and tailoring your approach. Because professional trading is centered on principles, testing, and candid self-evaluation, not replicating someone else's system, but crafting your own. This is your trading odyssey. Choose your tools.
Welcome to this enlightening exploration of your trading toolbox. Imagine you are perusing a menu of strategies rather than following a rigid script. This is about discovering possibilities, not merely following orders. Let's delve into your bias and context options for your higher time frame, where you shape your understanding of overall market direction and key structural levels. Begin with the ICT and smart money concepts approach, where we map internal and external range liquidity, predicting flows, discerning between liquidity sweeps and genuine trends. Identify fair value gaps and order blocks, using premium and discount analysis to assess price valuations. Next, explore the Wyckoff method. Determine whether price is in accumulation, markup, distribution, or markdown phases, paying attention to springs and upthrusts, and testing supply and demand zones. With Elliott wave theory, understand where impulse and corrective waves guide market cycles. Prefer simplicity? Trend and support resistance approaches track market swings and draw trend lines with precision. For technical purists, moving averages, VWAP, volume profiles, Bollinger Bands, and Fibonacci levels offer robust indicators of market dynamics. Shift focus to your entry and confirmation options. Utilize break of structure, liquidity sweeps, candlestick patterns, and technical indicators to identify trading triggers. Embrace the mindset of selecting and testing a few clear methods. Recognizing that all methods have strengths, build your personalized strategy aligned to your cognitive style and personality. Choose wisely, test thoroughly, and forge your unique path to trading success. Truly empowering, isn't it?
Right then, now I'm going to show you something absolutely crucial. 4 completely different top-down workflows, side by side. And here's what I want you to notice. They're all valid. They're all systematic. They're all capable of producing consistent profitability. Yet they're radically different in their approach. Let's start with the first workflow, the ICT and smart money concepts flow. This is liquidity-focused, institution-aware trading. On your higher time frame, you're creating a liquidity map. Where's the internal range liquidity? Where's the external range liquidity? You're identifying order blocks, those consolidation zones where institutions positioned. You're marking fair value gaps, price imbalances left by rapid institutional movement. And you're dividing your range into premium and discount zones using the 50% equilibrium. This gives you a complete map of where smart money is operating and where they're likely to push price next. On your intermediate time frame, you're refining those points of interest you identified on the higher time frame. Perhaps that order block on the 4-hour chart spans 60 pips. On the 15-minute, you narrow it down to the core 20-pip zone. You're confirming break of structure or change of character, validating that the market structure aligns with your bias. On your lower time frame, you're waiting for your entry trigger, a liquidity sweep into your refined point of interest followed by immediate reversal. That's your signal. You enter and you manage your trade to the nearest liquidity pool, taking profits as price collects each level. Clean, systematic, institution aligned. Now the second workflow, pure price action and support resistance. This is classical technical analysis stripped to its essence. On your higher time frame, you're identifying the trend. Are we making higher highs and higher lows, or lower lows and lower highs? You're marking major support and resistance levels where price has historically respected. You're drawing trend lines across swing highs or lows. Simple, visual, clean. On your intermediate time frame, you're refining those zones you marked. You're watching for specific price action patterns. Pin bars showing rejection, engulfing candles showing dominance, inside bars showing consolidation before continuation. On your lower time frame, you execute when you see rejection or continuation at your identified zones. Perhaps a bullish pin bar forms at support. You enter on the close. Perhaps an engulfing candle breaks through resistance. You enter on the retest. You target the nearest structural level, the next major high or low. Straightforward, no indicators, just pure reading of price. The third workflow, indicator and confluence-based trading. This is for those who prefer technical tools and mathematical confirmation. On your higher time frame, you're using the 250-period moving averages to define trend. If price is above the 200 EMA and the slope is positive, you're bullish. You're checking RSI to understand whether we're in an overbought or oversold regime. You're anchoring VWAP to significant structural points. You're measuring ATR to understand current volatility. These indicators give you context and regime identification. On your intermediate time frame, you're looking for confluence zones. Perhaps your 50-period moving average aligns with a Fibonacci 61.8 retracement, which also coincides with a daily pivot point and a prior support level. That's 4 factors confirming the same zone. That's your setup area. On your lower time frame, you trigger when price reacts to that confluence zone and you see confirmation. Perhaps a candlestick pattern plus a break of structure, or an RSI divergence plus MACD crossover. You scale out at predetermined targets based on risk-to-reward ratios or subsequent confluence levels. Methodical, multi-layered confirmation, statistically robust. And finally, the fourth workflow, Wyckoff and volume profile methodology. This is understanding market cycles and volume distribution. On your higher time frame, you're identifying which Wyckoff phase you're in. Are we in accumulation, where smart money is building positions? Are we in markup, the trending phase, upward? Distribution, where smart money is selling to late buyers? Or markdown, the trending phase, downward? You're also using volume profile or market profile to identify the point of control and value area, where most trading occurred, which acts as fair value and gravitational center for price. On your intermediate time frame, you're looking for specific Wyckoff events near these value areas or volume nodes. Perhaps a spring, a false breakdown below support on low volume that signals a reversal upward. Perhaps an upthrust, a false breakout above resistance on low volume, signaling a reversal downward. Perhaps tests of supply or demand that show smart money re-entering. On your lower time frame, you confirm the test, enter in the direction of the emerging phase, and target rotation back to value or break out into the next Wyckoff phase. You're trading with the institutional cycle, not against it. Now, here's what I want you to truly understand. All four of these workflows work. I've met consistently profitable traders using each of these approaches. They're not competing methods where one is right and the others are wrong. They're simply different ways of organizing the same market information. The ICT trader sees liquidity and order blocks. The price action trader sees support, resistance, and patterns. The indicator trader sees confluence and mathematical signals. The Wyckoff trader sees phases and volume distribution. They're all looking at the same chart, but through different lenses, and all finding profitable opportunities. Your job isn't to determine which is objectively superior. Your job is to determine which resonates with you, which you can execute consistently, and which your backtesting proves is profitable for your trading style. Test them. Try pure price action for 30 trades. Then try ICT concepts for 30 trades. Then try indicator confluence. Record your comfort level, your execution quality, your results. Let the data guide you to your optimal workflow. This is how professional traders develop, through systematic experimentation, honest self-assessment, and data-driven refinement. Multiple paths to the same destination. Consistent profitability. Excellent! Now we're going to break down your trading system into 4 fundamental modules. And this modular approach is brilliant because it allows you to mix and match components systematically, rather than feeling overwhelmed by the full complexity of market analysis. Think of these 4 modules as building blocks. Each module serves a specific purpose, and within each module you have multiple options to choose from. Your job is to select one option from each module, test that combination, evaluate the results, and iterate. Simple, systematic, data-driven. Let's start with Module 1, the Trend module, shown here in green. This module answers the fundamental question, what's the overall direction or phase of this market? Your options include market structure analysis. Are we making higher highs and lower lows for bullish, or lower lows and higher highs for bearish? Moving average slope. Is the 200 or 50 period MA angled upward or downward? Wyckoff phase identification. Are we in accumulation, markup, distribution, or markdown? Elliott wave degree. Which wave are we in within the broader cycle? Or ICT liquidity mapping. What's the current flow from internal to external range liquidity, or vice versa? Choose one, just one. Don't try to use all 5 simultaneously. Pick the method that makes visual and logical sense to you. If you understand Wyckoff phases intuitively, use that. If moving averages resonate with you, use those. If ICT liquidity concepts click, use that framework. One clear method for defining trend and phase. Module 2, the level module, shown here in blue. This module answers where are the key zones price is likely to react to. Your options include classic support and resistance zones marked from prior price action, order blocks and fair value gaps, those SMC and ICT specific levels, Fibonacci levels or fans, mathematical ratios derived from prior swings, volume-weighted average price or anchored VWAP, fair value levels based on volume-weighted calculations, or volume profile and market profile, identifying the point of control and value areas where most trading occurred. Here you can choose 1 or 2 methods if they complement each other. Perhaps you use support and resistance from price action plus Fibonacci confluences, or perhaps order blocks plus VWAP. The key is that your chosen levels should be clear, objective, and testable. If 2 independent methods both point to the same zone, that's confluence, that's powerful. Module 3, the trigger module, shown in red. This module answers what specific signal confirms my entry. Your options include break of structure or change of character, formal confirmations that market structure has shifted in your favor, liquidity sweep plus immediate reversal, stops run followed by sharp reversal, often the optimal entry point, candlestick patterns, engulfing candles, pin bars or inside bars providing visual confirmation, indicator signals, RSI divergence, MACD crossover showing momentum shifts, or VWAP touch and bounce, price reacting at the fair value level. Choose one. Your trigger must be specific and repeatable. I enter when price break structure is specific. I enter when it feels right is not. Define your trigger clearly so you can backtest it and so you can execute it without hesitation or emotional interference. With confident authority, Module 4, the risk module, shown in purple. This module answers, how do I protect my capital and define my risk-reward parameters? Cautiously advising, your options include structure-based stops, placing stops beyond key structure that, if broken, invalidates your setup, ATR-based stops and targets, using volatility to set appropriate stop distances and profit targets, fixed risk-to-reward ratios. Perhaps you always aim for 1-to-2 or 1-to-3, regardless of the specific setup. Scaling in or out strategies. Entering with partial position and adding or taking profits in stages. Or fixed percentage risk per trade. Perhaps you always risk 0.5 to 2% of your account. Giving practical advice, choose one approach and be consistent. Your risk management must be systematic, not emotional. Professional traders know exactly how much they're risking before they enter every single trade. Closing with strategic emphasis. Now, here's the rule of thumb that I strongly recommend. Start simple. Pick one from each module. That's it. 1 + 1 + 1 + 1 equals a complete trading system. Test this combination for 30 to 50 trades. Record everything. Evaluate the results. Only add complexity, additional confluence factors, multiple confirmation requirements if your backtesting proves that added complexity actually improves your edge without hurting your ability to execute consistently. Often simpler systems are more robust because they're easier to follow and harder to second-guess. Empowering tone. This modular framework transforms system building from an overwhelming mess into a systematic process. You're not trying to master everything at once. You're selecting one clear option from each category, testing that specific combination, and iterating based on data. Firm closing. That's how professionals build their systems, methodically, modularly, with constant feedback from results. Enthusiastic conclusion. Build your system one module at a time. Test it thoroughly and let the data guide your refinements.
Right then, now we arrive at the most crucial step of all, actually testing your approach. Because everything we've discussed, all these frameworks, all these modules, means absolutely nothing if you don't validate them with data. And I'm going to give you a simple, repeatable backtest plan that will transform you from a hopeful trader into a systematic one. Step 1. Pick one combination for 30 to 50 trades. Notice I said one, not 3 different approaches simultaneously, not I'll try ICT this week and Fibonacci next week. One specific combination tested consistently across 30 to 50 trades minimum. Let me give you 3 examples of complete combinations. Example A, ICT bias using internal and external range liquidity plus fair value gaps for your higher time frame context. Order blocks as your level type on intermediate time frame. Liquidity sweep as your trigger on lower time frame. ATR-based stops for risk management. That's a complete system. 4 modules selected, 1 from each category. Example B. Price action bias using higher highs and higher lows plus support and resistance identification. Support and resistance levels as your level type. Engulfing candlestick pattern as your trigger. Fixed 1-to-2 risk-reward ratio as your risk approach. Again, complete and testable. Example C, indicator-based, using 250-period moving average trend identification, confluence zones, where MA plus Fibonacci plus pivot points align as your level type, break of structure as your trigger, taking partial profits at predetermined levels as your risk management approach. Another complete testable system. Encouragingly, choose one. Write it down. Commit to testing only this combination for your sample size. Step 2. Define your rules in writing. And I mean explicitly, in detail that leaves no room for interpretation. What precisely defines your higher time frame bias? If you're using structure, define what constitutes a valid higher high or lower low. If you're using moving averages, specify exactly which periods and what slope angle or price position confirms trend. What qualifies as a valid level? If you're using support and resistance, how many touches are required? How old can the level be? If you're using order blocks, what makes one valid versus invalid? Be specific. What exactly is your valid entry trigger? If it's a candlestick pattern, define the pattern's characteristics precisely. If it's a liquidity sweep, how far must price move beyond the level before reversing? If it's a break of structure, which time frame structure must break? How will you set stops and targets? If structure-based, beyond which specific structure? If ATR-based, how many ATR units? If fixed risk-reward, what exact ratio? Define everything before you begin testing. Step 4. Forward test or bar replay and meticulously log each trade. Use historical data with bar replay software or forward test on a demo account. For each trade, record the setup type and which rules were met, whether it won or lost. The R multiple. How many units of your risk did you make or lose? Maximum adverse excursion. How far price moved against you? Maximum favorable excursion. How far it moved in your favor before you exited? Time in trade. How long from entry to exit? And crucially, notes about your emotional state and execution quality. This data is gold.
It tells you not just whether your system works, but how it works, where it struggles, and whether you can actually execute it consistently. Step 4. Evaluate comprehensive metrics after your sample. Calculate your win rate. What percentage of trades were winners? Your average R multiple. On average, how much did you make per unit of risk? Your expectancy. The mathematical edge your system produces. Maximum drawdown. The worst losing streak in R multiples. And, subjectively, your comfort score. How did it feel psychologically to execute this system? All of these metrics matter. A system with a 70% win rate might seem attractive, but if the average winner is smaller than the average loser, it's still losing money. A system with a 40% win rate might seem poor, but if winners are consistently 3 times the size of losers, it's quite profitable. You need the complete statistical picture. Step 5. Iterate one module at a time. This is critical. Don't change your entire system based on 30 trades. Change one component. Perhaps you keep your ICT bias and order block levels, but you switch from liquidity sweep trigger to break of structure trigger. Test another 30 trades with this one change. Compare the results. Or perhaps you keep your bias, trigger, and risk approach identical, but you swap from order blocks to Fibonacci levels. Again, 30 trades, record everything, compare the results. This systematic iteration isolates which components are working and which need adjustment. Step 6. Once you've found the combination that shows statistical edge and psychological comfort, forward test it live in a simulation account. Real-time execution, managing emotions as if it were real money, but without actual capital at risk. If you remain profitable and can execute the rules consistently, then and only then, transition to small live positions. Start with the absolute minimum size. Your goal initially isn't profit. It's proving you can execute your system with real money and real emotions. Once you've demonstrated consistency with small size, gradually scale up as your confidence and capital grow. This is the process. This is how systematic traders develop profitable approaches. Not through luck, not through guru worship, not through hoping. Through testing, iteration, data analysis, and honest self-assessment. Follow this plan and you will know, not guess, but know whether your chosen approach works for you.
Market Adaptation Checklist. 10 questions to guide your top-down approach. Before you apply your top-down system to a new market, asset, or session, pause and run through this 10-question checklist. Think of it as your pre-flight checklist before taking off into live trading. Question 1. What is this market's personality? Is it trending, range-bound, or choppy? Each market has its own character. Forex major pairs often trend smoothly, while certain altcoins can be erratic. Know what you're dealing with. Question 2. Which session or time window will I trade? Asian session liquidity differs vastly from London or New York. Your top-down bias might work beautifully during one session, but fail in another. Be specific about when you'll be active. Question 3. What's my time frame stack for this market? The 4-hour, 15-minute, 5-minute configuration works brilliantly for Forex intraday trading, but will it work for a slow-moving commodity or a volatile cryptocurrency? Adjust your stack to match the market's pace. Question 4. How will I determine bias on the higher time frame? Will you use market structure, moving averages, Wyckoff phases, Elliott wave, or ICT liquidity mapping? Choose one method that aligns with this market's behavior and your trading style. Question 5. What levels or zones will I mark on the higher time frame? Are you identifying support and resistance, order blocks and fair value gaps, Fibonacci levels, VWAP, or volume profile zones? Be clear about what you're marking and why. Question 6. Do I need an intermediate time frame for this market? Some markets are so liquid and well-behaved that you can skip the middle time frame entirely. Others require that extra layer of refinement. Decide based on the market's complexity and your confidence level. Question 7. What will trigger my entry on the lower time frame? Is it a break of structure, a liquidity sweep with reversal, a candlestick pattern like an engulfing or pin bar, an indicator signal such as RSI divergence, or a VWAP touch? Define your trigger clearly. No guesswork allowed. Question 8. How will I size positions and place stops? Are you using structure-based stops, ATR-based stops and targets, a fixed risk-to-reward ratio like 1:2 or 1:3, a scaling in or out strategy, or a fixed percentage risk per trade, such as 0.5% to 2%? Your risk management must be concrete and consistent. Question 9. Do I have enough backtest data for this market? You need a sufficient sample size, ideally 50 to 100 trades, before you can trust your system's edge. If you don't have the data yet, start gathering it now.
Excellent! We've now arrived at Section 10, Key Takeaways and Best Practices. This is where we distill everything we've discussed into the essential principles you must remember. Pay careful attention, because these takeaways are the foundation of consistent trading success. Firstly, you don't need more than 3 time frames, maximum 3. This is crucial to understand. More time frames do not equal better analysis. In fact, beyond 3, you're likely to create confusion rather than clarity. 3 time frames, higher for bias, intermediate for refinement, lower for entry. That's comprehensive yet manageable. Don't overcomplicate this. Secondly, always start with market structure. Before you look at indicators, before you check Fibonacci levels, before you do anything else, identify the market structure. Is price bullish or bearish? Are we making higher highs or lower lows? What's the type 1 trend and what's the type 2 behavior? Structure first, always. This cannot be negotiated. Market structure tells you the story of what the market has been doing and where it's likely headed next. Everything else, your points of interest, your entry signals, your targets, should be built upon this structural foundation. Get the structure right and everything else becomes significantly easier. Third, refine your points of interest as much as possible. Don't trade from massive, vague zones. Narrow them down. Drop to your intermediate time frame. Look within those larger zones. Find the specific areas of highest probability. Refinement improves your risk to reward dramatically and increases your win rate. It's worth the extra analytical effort. Fourth, backtest every strategy. I cannot emphasize this enough. Do not trade a strategy live until you've proven to yourself through historical data that it works. Go through months of charts, identify your setups, calculate your statistics. This backtesting phase is not optional, it's mandatory. It's the difference between systematic trading and hopeful gambling. And when I say backtest, I mean properly. Not just glancing at a few charts and thinking, yeah, that looks good. I mean detailed, recorded statistical analysis. Win rate, average risk to reward, maximum drawdown, consecutive losses. Know your strategy's characteristics intimately before risking capital. Fifth, keep it simple. Don't overcomplicate your analysis. You don't need 15 indicators, 3 different trading methodologies, and 5 types of confluence factors all at once. Clean price action, clear market structure, and systematic top-down analysis. That's all you need. Complexity doesn't improve results, it creates confusion. Now, let me add something that might not be on the slide, but is absolutely critical. Discipline trumps methodology. You could have the most brilliant trading strategy ever devised, but if you don't follow it consistently, it's worthless. Trading success isn't about finding the perfect strategy, it's about having a good strategy and following it religiously. Also, understand that losses are part of trading. Even the best strategies lose sometimes. What matters is that your wins are larger than your losses and that you have enough wins to be net profitable. Don't judge your trading by individual trades. Judge it by your results over dozens or hundreds of trades. These takeaways might seem simple, but implementing them consistently requires discipline, patience, and dedication. Review these principles regularly. Let them guide your trading decisions every single day. These principles underpin consistent profitability.
Right then, let's discuss best practices for consistent results. These aren't just suggestions, these are the habits that separate consistently profitable traders from those who perpetually struggle. First, stick to your trade plan and chosen time frame flow. This sounds simple, but it's where most traders fail. You've done your backtesting, you've established that your 4H, 15-minute, 5-minute configuration works, and you've documented your entry criteria. Brilliant! Now, follow it. Every single time. No exceptions, no just this once modifications, no emotional adjustments mid-trade. Your trading plan exists specifically for those moments when your emotions are screaming at you to deviate. When fear tells you to exit early, when greed tells you to hold longer, when impatience tells you to enter before your confirmation, your plan is your anchor to rationality. Trust it. Secondly, move your stops to break even whenever possible. Once price has moved significantly in your direction and you've taken partial profits, moving your stop to break even transforms your trade into a risk-free opportunity. The psychological benefit of this cannot be overstated. You're now playing with house money, so to speak, and even if price reverses, you've still profited on the position you closed. Now, the key word there is possible. Don't move to break even too early and get stopped out unnecessarily. Wait for price to break through a significant level or achieve a meaningful target first. Use price action milestones, not arbitrary pip movements. Third, use kill zones for timing your entries when helpful. Kill zones, periods of high institutional activity like the London Open or New York Open, often provide the most favorable trading conditions. Price tends to move more decisively during these periods, liquidity is higher, and your technical analysis tends to be respected more reliably. If your strategy allows it, focusing your trading activity during these optimal windows can significantly improve your results. You're not fighting thin liquidity or erratic price action, you're trading when the big players are active. Fourth, price efficiency and unfilled gaps matter. Pay close attention to how price has been moving. Has it been leaving fair value gaps everywhere, or has it been filling them systematically? When price is being efficient, filling gaps as it goes, that tells you something about market character. When it's leaving gaps, that suggests strong directional momentum. Unfilled gaps often become magnets for price. If you see a significant fair value gap that price hasn't filled yet, that's a potential target or entry area. Don't ignore these inefficiencies. They're part of the market's natural behavior. Fifth, stay patient and analyze your results. Trading is the long game. You won't become profitable overnight, and individual trades tell you almost nothing about your strategy's viability. You need statistical significance, dozens or hundreds of trades before you can properly evaluate your approach. Keep detailed records. Use a trading journal. Note not just your profits and losses, but your emotional state, market conditions, what worked and what didn't. Review this journal regularly. Look for patterns in your winning and losing trades. This analytical approach to your own performance is how you improve systematically. Also, be patient with the market. Not every day offers high-quality setups aligned with your strategy. Some days, the best trade is no trade at all. Professional traders are comfortable sitting on their hands when conditions aren't favorable. They don't force trades out of boredom or a need for action. One final best practice: continue learning. The markets evolve, your understanding deepens, and there's always room for improvement. But, and this is crucial, don't
constantly switch strategies. Learn and refine within your existing framework rather than endlessly searching for the perfect system that doesn't exist. These practices, implemented consistently, create the foundation for long-term trading success. They're not glamorous, they're not exciting, but they work. Consistency in process yields consistency in results.
Well then, we've arrived at the conclusion of our comprehensive journey through top-down analysis, and I must say, if you've stayed with me throughout this entire presentation, you're demonstrating the exact quality that successful traders possess: dedication and a willingness to learn. Let me be perfectly frank with you. Mastering top-down analysis takes practice and dedication. It's not something you'll perfect after watching one presentation or reading one book. This is a skill that develops over time through consistent application, through making mistakes and learning from them, through backtesting and live trading experience. But here's the encouraging news. The methodology we've discussed is fundamentally sound. It's not some fly-by-night strategy that will stop working next month. Top-down analysis is how institutional traders approach the markets. It's how professional traders think about price action. You're learning a methodology that will serve you throughout your entire trading career. So, what are your next steps? Well, first and foremost, practice. Take what you've learned here and apply it to your charts. Start with historical analysis. Go back through months of price data on your chosen instrument and time frames. Identify market structure. Mark out points of interest. Find where your entry signals would have occurred. This backtesting phase is absolutely crucial. Then, once you have statistical evidence that your approach works, move to demo trading. Trade a demo account as if it were real money. Follow your rules, manage your risk, record your results. Demo trading allows you to develop your execution skills without risking capital. Don't skip this phase. It's where you build confidence and refine your process. When you're consistently profitable in demo over a significant sample size, I'd suggest at least 3 months and 50 trades, then and only then should you consider live trading with real capital. And when you do, start small. Use the absolute minimum position size. The psychological difference between demo and live trading is substantial, and you need to adjust to that mental shift with minimal financial risk. Now, I also encourage you to seek feedback and connect with trading communities. Join forums, participate in Discord groups, share your charts and analysis. But, and this is crucial, be selective about whose advice you follow. There's tremendous value in community, but there's also a lot of noise and bad information. Find traders who are genuinely helpful, who trade similar methodologies, who demonstrate consistent results. If you have questions, and you undoubtedly will, don't hesitate to seek answers, but always filter advice through the lens of your own backtesting and experience. What works for one trader might not work for you, and that's perfectly fine. Keep learning. Trading is a lifelong educational journey. Markets evolve, your understanding deepens, and there's always another layer of sophistication to explore. But whilst you continue learning, maintain consistency in your approach. Don't constantly switch strategies. Refine and improve within your established framework. And finally, remember, trading success is not about being right on every trade. It's about having a systematic approach, managing risk properly, and being consistently profitable over time. Focus on the process, not individual results. Trust your system, follow your rules, and the results will take care of themselves. I want to thank you sincerely for your time and attention. I genuinely hope this presentation has provided you with valuable insights and practical tools you can apply immediately in your trading. I wish you tremendous success in your trading journey. Stay disciplined,
stay patient, and most importantly, never stop learning. Best of luck to you all. Trade well.
Well done, everyone. If you've made it this far, you've completed what is quite possibly the most comprehensive training on top-down analysis available. I know this has been an extensive journey, perhaps the longest educational video you've encountered on day trading, but I truly believe it was worth every minute. This material represents months of careful preparation. I've poured my heart and soul into creating something I wish I'd had access to when I was starting out, and now it's yours, completely free of charge. So please, make the most of it. Study it thoroughly. Apply these principles consistently. If you found value in this training, I'd be tremendously grateful if you could leave a like, comment, and subscribe. Your support means the world to me. Before we part ways, I'd like to leave you with a piece of wisdom that has guided me through my own trading journey. It comes from Psalm 46, verse 10. Be still and know that I am God. When you slow down and place your trust in Him, peace follows. But you must slow down. You must trust. Now, I encourage you to follow me on social media and join our Discord community. If questions arise as you begin implementing these strategies, don't hesitate to ask. I know the Discord may seem quiet at times, but I'm there regularly, checking messages, answering questions, reviewing chart analyses. I promise you, I'm present, even when it appears quiet. The community will grow more active as I continue developing additional content, but for now, please join us. That's all I have for you today. I'll see you in the next session. Until then, trade wisely and stay disciplined. All the best.